JJ the CPA here. Hope you're doing well. Thank you for joining us for the Q&A ERTC seminar number 3. Thanks for those that are here live. Of course, I'm going to record this and put it up to the ERTC website. Full disclosure, I am going to release this on YouTube. This was free to attend. It wasn't a part of the seminar. It's an add-on to the seminar. And part of the reason to put this out there is for those that are still trying to figure out the employee retention tax credit. I put together a seminar that you can have immediate access to. There's a link in the body of this video that you would be able to go and check it out. This Q&A is only for those that attended the live seminar. If you purchase the seminar now, you won't have an opportunity to ask a question. And that's one of the benefits of being a part of the original seminar, so to speak. So let's get into the Q&A. Again, this is based on the seminar number 3. And of course, we have the disclaimer for those that didn't take the seminar. Read this carefully, hit pause on your video and read it very carefully. We're going to do Q&A on the employee retention tax credit. I'm going to provide answers in red. Please note that you will not get the complete answer to any question listed by only reading the answer in red. You must get my complete answer by listening to the answer I provide verbally as well. By simply reading the answer on the slide is not to be considered a complete answer. The answer listed is in red, and it's just the sum of the answer for outline purposes only. The answer is specific to the information as provided. Any answer to any question of any kind, of course, in any circumstance, could be different if different or additional facts were presented. If you did not submit the particular question, the answer most likely would be different under your circumstances. And this is, of course, for informational purposes. And just like anything, consult your tax professional before acting, in the sense that they would have all of the information relevant, and they're the ones that are filing the return with you. So question number 1, we've got from Jace, and my tax attorneys keep telling me the credits are only available for wages paid during the qualified periods not earned or incurred. I am currently taking wages paid on April 9th and applying these wages evenly across the 14 days ending pay period April 4th, so much as those wages paid in QT are services provided in Q1. Can you please expand on what my offense would be if I was challenged by the IRS? So I'm going to go ahead and read my answer, and then I'll expand on it on each of these slides. So the ERTC is based on a qualifying period of time, either the time of governmental order or the quarter of qualifying decline in gross receipts. Was earned, incurred during that specific time period are the only wages that would qualify. Wages actually paid during that time, that would be wages earned or incurred in a period before or after the qualifying period, would incorrectly possibly increase the employee retention tax credit. The SBA for PPP is specific to state paid and incurred. Of course, ERTC is not directed by the SBA, and of course doesn't follow any PPP rules. So if the argument by chance is PPP is paid and incurred, of course it carries no merit with ERTC, as the IRS oversees the ERTC. So what I would say is that for the tax attorneys is that I know sometimes we get specific to looking at ERTC and what is it for ERTC purposes and how does it work for ERTC? But we do have to remember that we're talking about ERTC that has been in existence before. It has been modified and included in the CARES Act. So there is precedent to go and look at, number 1. Number 2, when there's an area potentially of, for lack of a better word, gray, or maybe it's not as straightforward as potentially the person is thinking, you can also rely, in my opinion, on, well, how do other credits work? And when you look at other credits, other payroll credits, that is, it is based on the wages during a specific period of time. The work opportunity tax credit for payroll is only wages during the time of qualification, just as a minor example. Now, I do recognize that over and over, the IRS will say, for ERTC purposes, for ERTC purposes. So the thing to note here is that with the employee retention tax credit, when you look at the rules or the law now that the IRS has put out there about qualifying wages, when you look at the rules about the qualifying time period, when you really look at it as it relates to governmental shutdown, it goes, in my mind, into extreme detail of defining the wages during that time period. I understand that the Family First Coronavirus Response Act is a separate law from the employee retention tax credit, but it's another one that we can look over to, because when you're looking at the sick and family leave tax credit or the sick and family leave tax credits that are both in there, it is specific to what was the payroll for that person that day. Now, I know that with the IRS and in 2021-49, we talked about in the seminar that for income tax purposes, that they indicated that any payroll in 2020 that yielded a employee retention tax credit, even if that was filed for after the close of the year, so even if it was filed for in 2021, even if the credit was experienced or received in 2021, IRS notice indicates that that tax credit needs to be reflected in 2020. And that would be then lining that up. So that was shocking to me. But that is for income tax purposes. I understand it's tied to the ERTC. The other part is that when we're looking at the rules and regulations of filing payroll reports, there's a set of rules that we look at when we're talking about that. So what I want to really clear away is that when we're trying to define for ERTC purposes, we're not looking at the payroll rules as it relates to the time period. We're not looking to in terms of when you report it for payroll purposes, and we're not looking at it from income tax purposes. We're actually looking at what wages qualify for the credit. So you have to really just narrow it down. And what I'm trying to do, I understand that I just talked about other tax credits and I talked about other things, and that's just as professionals, as we come up with our opinion, we're using our experience and how does it work with this? And when even looking at the other credits, you can look and go, well, but the ERTC is different in this way. So even if you're looking at PPP or ERTC with the work opportunity credit, part of the reason to look at it is to go, oh, well, but ERTC is different in this way. So what I would really boil it down to is that if your tax attorneys are advising you that it's when it's paid, you'll have to just obviously make a decision if you're going to follow what they're saying. It doesn't seem reasonable to me. And many, many times the law comes down to, well, that wasn't reasonable, or your interpretation wasn't reasonable. So if you really boil it down and you look at qualified wages, and it talks about qualified wages during the period of time when the employer qualifies. So whether it's the governmental shutdown or whether it's for the quarter. So if we look, as I'd indicated earlier, you look specifically, and when they go into lots of detail about the governmental shutdown and the way that they describe the governmental shutdown, and then the way that they describe that period, they, in my opinion, go into great detail for me to draw a conclusion that it's clearly based on wages of the day of the qualifying period, not when it's simply paid. Doesn't seem reasonable to me. So it wouldn't be reasonable for me to argue to the IRS that, well, we paid a bunch of bonuses at the beginning of the qualified period that were based on the prior year. So we feel that they count for ERTC. Now, What we have to remember here is that when we're trying to make arguments like this with either for or against or defending a position with the IRS, we have to remember, I know we get a little caught up between Q1 and Q2, but whatever our position is, then you would look at it as, okay, well, would it be reasonable in all circumstances? So when we're talking about these wages and when they're paid, and we're not looking at 941 rules, we're not looking at 940 rules, we're not looking at W-2 and W-3 rules, we're not looking at income tax rules. What we're looking at is the ERTC rules. So to me, if someone were to qualify in Q1 and there were bonuses and they were declared and here's what your bonus is going to be, and then they're paid out in Q1, to me, that is not wages in Q1. That would be wages to the prior year. It wouldn't be reasonable. I don't think the IRS would conclude or tax court would conclude that it would be reasonable for somebody to include bonuses that were not earned during that period of time. So let me back away from bonuses to say, so when you're now looking at wages, well, what was incurred during that period of time? I also think that it can lead to manipulation of the law. And that's typically where the IRS, at least later, could become more aware and have additional discussions or rules or additional information about this. And typically where we know the IRS typically will come out with more additional information is when they start to see, well, how was this manipulated? And therefore we better come up with some rules to indicate that you can't do that. And many times with the IRS, that's going to be retroactive. So for me, it doesn't seem reasonable that if somebody were to qualify, let's say coming up now in Q3, and they go, hey, we're going to go ahead and pay out wages that we would normally pay in October. We're going to go ahead and pay them out at the end of September because we know we're going to qualify in Q3 of 2021. And we'd like to have more wages so that we're maxing out the credit. So why don't we go ahead and pay wages at the end of September, even though we would normally pay those in October? That wouldn't fly. That doesn't seem reasonable. So again, going with, well, no, it's based on when it's paid, as in, here's your paycheck. I don't see how that works in any circumstance. I only see it in a way that increases the credit, and I don't see it to be reasonable. Now, when you look at the rules, I think what's unfortunate is the rules will say paid, but when you then really look at, in my opinion, what the intention of the word paid is, paid in the time period. So I think, and with all due respect to a tax attorney, it seems a little naive. It seems a little, and I don't mean with any disrespect, but it's as though they're only defining paid as one interpretation, paid as in, here's the check to you, employee. When you look at the intent of the word paid for the day, in my opinion, then that's what allows for it to only be for the wages during that period of time, which would mean incurred. So again, when do you report for 941? It's when it's paid, but we're not talking about 941. We're talking about the actual employee retention tax credit. So you are going to see in 2021-49, it might have been the first time that I noted the IRS to use the actual word incurred, but it said for income tax purposes, whether it was incurred or paid in 2020, it needs to be reflected in 2020. But again, when you look at the word paid, I think we're being a little naive if we just assume that paid means it's just when a check is written. I look at it as the employer owes that employee that money that day. They've simply chosen to pay it at a later date. The employee has decided to agree in allowing to be paid at a later date. But that employer owes that money, and technically the pay for that day is what that employee worked. Trying to finagle timing, I think, only leads to a higher ERTC credit. So I stand behind the incurred. I stand behind, when you look at the intent, and the descriptions of qualifying wages and qualified period, that it seems crystal clear for me from the very beginning that it is what that employee earned for that day. Now, what we look at in a practicality standpoint, and I wouldn't do this at all, but practically, if the credit is really no real difference there, then the IRS could make an adjustment, but it may not actually adjust the tax credit, if that makes sense. But at the same time, I feel it would be incorrect, unreasonable, would yield a result of an adjustment. An adjustment would result potentially in tax due or credit repayment, would result in penalties and interest if you went by when it was a check cut to the employee versus, well, here's what that employee earned during that day. So I do appreciate that you have a tax attorneys, but do remember on any tax return, payroll, income, etc., you're the only one responsible. The IRS and the courts will never, ever, ever allow you to get out of a tax adjustment because you relied on professional advice. Doesn't matter that it's a tax attorney. Now, they may use it that you took a reasonable stance and they may be lenient on penalties in essence, but it's never going to be a defense that I hired a tax attorney or a CPA or an EA, or I relied on a professional, or I relied on their advice. The only person responsible is the business owner and or the person that's in charge of payroll and is going to be held, the ones that would be held responsible by the IRS. So instructing your tax attorneys, which I don't know that a tax attorney would be filing your actual 941s and 941X, but there's nothing wrong with saying, listen, we're going to go with when it was incurred. And I think you would be doing it in a way that's probably less of a credit. I don't see that that yields a higher credit, and I would see that that's reasonable. So to me, a tax attorney finding a larger credit for you, being tempted to take the larger credit based on a tax attorney's advice, I think would be a misstep. And I think the intent of this is for the credit to be what an employer paid to an employee during the time period that qualified for ERTC, paid not meaning when they handed them a paycheck. All right, then the second question from Jace, can you please clarify the 2020 claims process as compared to your previous instructions? Jace, thank you for paying so close attention to reference both seminars. I really appreciate that. In seminar 2, you said we can claim all of 2020 on the 941X for Q4 20 and mark it as refund. So some of this stuff's kind of an obvious, but I was just pointing out the date of the second seminar, of course, was 3/19. First quarter 2021 had not ended, of course, so we were in obviously a different time period, that's obvious. And at that time, filing all of 2020 ERTC in Q4 was allowed per the actual law enacted 12/27/2021. And Jace, I know as closely as you were paying attention to the seminar, you know I went into great detail about that in dissecting the actual law, but then also the IRS had indicated on 1/22/2021, I'll update, well, I'm not updating because I'm not providing, but in 1/22/2021, and I've already provided a link in the seminar webpage to that, the IRS had indicated that you could report it all in Q4. Now I understand they provided, you know, under these circumstances and that circumstances, but collectively in seminar 2, based on the law, based on that IRS notice, based on the fact that we were still in first quarter of 2021, at that time, we would be able to file and do it all in fourth quarter. I will tell you this, I have clients, and that's exactly what we did at that time. We filed ERTC credits that were in second and third quarter, but we filed a 941X for fourth quarter. For the 3 clients that were with a different payroll company that we had to do that with, one of them they've gotten real jittery about, well, why haven't I got my money? So we've had to call a couple of times just to appease the client. And they've indicated that they've received it. They're just going through it. At the end of the day, I think the IRS, with being inundated, if that's how it was filed, they're going to accept it. Now, what you've indicated, though, in Seminar 3 is that I've said differently. So per the IRS announcement on 8/4, of course, we now have the benefit of the experience between March and now, but per the IRS announcement on 8/4, there's a link on the seminar webpage. The IRS indicated to file the ERTC for each quarter. So see the bottom or see the bottom of the announcement under the title reporting. So you'll see that at the bottom of the announcement. So they indicate that they want you to file it quarter by quarter. In Seminar 3, so Jace continues, in Seminar 3, you said to create a 941X for each quarter 2020. So again, I didn't put that in red just by accident, but I'm just referring back to the IRS announcement on 8/4. But then you're noting, Jace, that I also said in Seminar 3 to mark it as an adjustment to carry forward. And you're noting that in Seminar 2, I said to mark it as refund. So I only stated to mark it as adjustment to carry forward in Seminar 3, based on the experience we now have that the IRS is understandably but extremely backlogged. And based on my personal experience, no refunds from Form 941Xs related to the ERTC have been received, whether 2020 or 2021. In Seminar 2 in March, of course, we didn't have the benefit of realizing the IRS's delay in refunds. You can still elect to receive a refund. So, and I'm sure everybody's aware of this, and I know Jace is as well, but of course, we always have had the option on Form 941X or 941 to request a refund or to get a credit carry forward. The clients that we had filed, we requested refund. It really wasn't until probably maybe June or July that it started making sense. Well, maybe we need to mark these for a credit carryover. And where we started thinking about that again is that we have clients that, unbeknownst to us, they ended up qualifying for Q1 due to the gross receipts reduction test. But we didn't know that at the time they were filing the 941s. So we are having to go back and amend 941s. Now this is for 2020. And it just made sense to me that, well, if we're having the backlog, then let's go ahead and mark it for a carryover credit. And in the IRS's instructions in 941X, if you attended Seminar 2, which Jace obviously did, in that seminar, I had a video on how to prepare the 941X. I didn't include it in this seminar, and in part because there's going to be a brand new 941X coming out probably at any time that would update what we would be calculating, but I digress. In the 941X instructions, it indicates that if you are marking it as an adjustment credit carry forward, the timing of when to do that. And in essence, what they're giving you as a rule of thumb is to time any 941X that you're filing with an adjustment to carry forward, before the 941 is being filed, that you're going to take that credit on. And I'll let you read the instructions because it's beyond the answer here. But in the instructions, what seems clear to me is that if you were filing a 941X for Q1 2021, and you're going to now take that credit carryover, but you're going to take it on 941 Q3 because you already filed Q2 941, that the timing of right now, September 1, or I guess we're August 30th, but right around September 1 would probably be about the last time period you'd want to file a 941X to take a credit on Form 941 for Q3. I'm being very specific here. So anyways, read that, because if you are going to do the adjustment to carry over, take a look at that. So thanks, Jace, for both of those questions. Jace continues here. For ease of reporting and reconciliation, we would rather execute your first instructions. However, we had a payroll company tell our client that we need to file separate 941X for each quarter. Has your interpretation changed on whether all 2020 could be filed in 941X Q4? So simply based on the IRS announcement 8.4, it seems as though you would want to file quarter by quarter. I do note here that per 941 and 941X instructions, that if there's any ERTC in first quarter 2020, that it be reported on second quarter 2020. So I apologize. This is why I wanted you to hear my answers. That is a typo, that I say first quarter 2020 can be reported on second quarter 2021. That is just a typo. You would not report first quarter 2020 ERTC on second quarter 2021. You will report ERTC first quarter 2020 on second quarter 2020 of Form 941. And then, of course, Form 941X rules follow there. So quarter by quarter. I don't know what the IRS would do if it was all recorded in fourth quarter. And the reason I say that is that they don't know what quarter any of it was in reality anyways, but that's not a reason for us just to go ahead and do Q4. All I'm saying is that when you file a 941, all you're saying is here's the wages. There's nowhere on there you're declaring anything. I know that you're declaring the number of employees that you had now based on 2019, but you're not indicating if you're doing it due to gross receipts reduction. You're not indicating if you're doing it to governmental shutdown. You're not indicating what time period that your governmental shutdown is. All you're indicating is you're filing a 941 or 941X for wages that were paid, as in the amounts that were paid to the employee in that specific quarter. Because remember, for 941, 940, W2, W3, 941X purposes, you're reporting based on when it's paid, which goes back to your original question of, well, what gets included in the credit? It doesn't matter when it shows up on a 941, 941X. In theory, what matters is wages during that period of time. But then you're reporting it on these based on when it's paid, but that's not how you're reporting the credit. All right, question 3 from Jace. This new process for calculating and reporting of ERTC seems incredibly burdensome for a business. Of course, I agree. So I just want to clarify my understanding and ask the risk of simplifying. Let's say a business qualifies for Q2 21 and a paycheck falls on July 2nd for a week ending June 27th, and no employee reaches 10,000. So I think what Jace is indicating is that by July 2nd, it doesn't change the fact that employees would have reached the 10,000 mark. Continuing with this question, qualifying wages include the entire paycheck from July 2nd, and then there would be 3 of 7 days of the paycheck from July 9th. And what I believe he's indicating there is that those 3 days obviously would be the end of June included in a July 9th. Those are qualifying wages in Q2, and yet we will not report those until Form 941 for Q3. So now, this is a completely separate question. And what we're talking about in this question is, when do you report the wages for 941 purposes? This isn't about, well, what wages get included in the ERTC. This is simply, well, here's the ERTC, here's the wages that qualify. Now, when do I report those wages? And when do I report the credit? Okay. So when following normal reporting rules of 941, 941X, W3, W2, and 940, you report everything as of the date it was actually paid to the employee. Therefore, I would recommend such wages and related ERTC be reported in third quarter, even if the business does not qualify for ERTC in third quarter, because Form 941 does not determine the quarter of taking ERTC. The qualifying wages are the qualifying wages, even if paid to the employee after the end of the quarter. Taking a tax credit and reporting wage on payroll forms are not the same routinely with other tax credits. The rules of when to report wages on Form 941, et cetera, have not changed. So as it relates to this, what we do want to remember is that we got to look at what wages are included in the ERTC. We define that and we say, here's the ERTC wages, and included in ERTC wages is then the employer health insurance. We identify what those wages are. Then we go, well, now when do we report them on 941? So I like it that Jace had a third question here, because in essence, it's the next step. And on Form 941, et cetera, as I indicated, you're not at all indicating in that quarter that you have information of how you qualified and what's the time period, et cetera. So it's not that if I'm going with a reduction in gross receipts, all wages in second quarter have to be recorded in second quarter. Now, someone has a question later, and we're going to talk through the practicality of this. I think what's more important to get right is that you're only including the proper amount of wages during the qualified time. I think secondary, if the IRS were to indicate, well, you didn't report it on the right Form 941, okay? I'm going to talk later about the practicality of it. It wouldn't change the credit. What's more important to get right here is the credit. So if there's conflicting opinions on when you report it, what Form 941, that doesn't make sense to me. It is a secondary issue. I do think there's a right way to go about it, was what I'm indicating. So Jace continues. So if those mechanics are correct, what is the risk of simplifying all of this and just basing it on when the qualified wages are paid? I know that we may be underclaiming depending on how paychecks fall beginning end of the quarter, but underclaiming aside, the legislation and code both use the term paid instead of earned. So what would you expect of the IRS? Would they do the math to assess penalties and interest, or would they see that you took a reasonable and consistent approach in the spirit of the law? For what it's worth, I've never had to defend myself before the tax court, so I'm trying to make an educated decision with your experience and the attorneys who will need to defend me, my client. So in a practical sense, as long as the only wages included in the ERTC are those wages that qualified during the qualified period, that will be the IRS main concern. Possibly reporting ERTC wages and the correlating credit in a different quarter than when paid would result in the non-refundable and refundable portion of the tax credit differing. However, that does not affect the actual ERTC, as the ERTC is simply the credit regardless of the non-refundable and refundable portion. Because I don't see that the dollar amount of the credit would be any different, and penalties are typically based on tax differences, any penalty would have to be simply a reporting penalty, which is also mostly based on the timing of when taxes paid. Penalties for late payment of payroll taxes have several kinds, and so of course you need to consult the tax preparer on what would apply to you, if any. Later I talk about, and I give somebody a kind of my off the cuff, what I would tell a client in terms of the number of penalties. But I think what's key here, Jace, is that if you're following a reasonable and consistent approach in what you believe to be the spirit of the law, or your customer's spirit of the law, that's obviously our first winning defense. Second, if you're underreporting, for lack of a better word, I think that also goes a long way, so to speak, of the intent not being you're taking a stance to maximize a credit. And then I do understand the legislation and the code both use the term paid instead of earned. My interpretation, and that's obviously the joy of the tax law, is that when they say paid, they're not, in my opinion, they're not talking about when you actually hand the check to the employee. And let me be maybe more expansive on that. We know that when we look at IRS payroll tables, like in terms of the withholdings, they have tables for a daily period of time of pay. They have a withholding table for weekly pay. They have a withholding table for biweekly. They have a withholding table for semi-monthly. They have a withholding table for those that get paid quarterly. They have a payroll withholding, I think, even if somebody's paid annually. I may be wrong on that, but nonetheless, what we have to remember is that when we're looking at not just our client circumstances and we're looking at just the law in general, my argument would be, well, what if somebody were closed down for 5 days? And during that 5 days, no employees got a paycheck in hand. No payroll was cut, if you will. Does that mean that that employer doesn't get an employee retention tax credit because the 5 days that their government shut them down, they didn't actually cut a payroll? That doesn't seem reasonable to me. So I don't know that we get to have it both ways. I don't think that if somebody were to pay monthly and for whatever reason they paid because it was monthly, let's say that at the end of 2020, they went ahead and paid everybody for January at the end of December. But then after that, they just followed their normal payroll. And now, if you're really following, there could be possible that a quarter only has 2 months of payroll actually paid to the employees during the quarter, when in reality, there was payroll for 3 months. So my interpretation of the word paid, and I mean it with all due respect, seems naive to mean it's only the time period of when we're handing money to the employee. All right, thanks again, Jace. I enjoyed going through all that. Question from Mac. So question regarding revenue interpretation, allocation for 2019 to be used in the 2020 gross receipts test for the employee retention tax credit. So here's the background. Privately held C corporation included Form 3115, application for change in accounting method to convert from accrual to cash on the federal 1120 filing 2019. Thus, total income on Form 1120, line 11, was significantly increased, nearly 40%, for 2019 tax year by a single entry of other income on line 10 of Form 1120. The entry was for payments received for prepayments or unearned work previously accrued, booked as income on conversion from cash, conversion from accrual to cash. IRS granted automatic consent for changing the accounting method for the small business taxpayer per revenue procedure 2018-31, section 1519 under DCN 3233, which is awesome. That's a lot of hard work right there. I know it's an automatic and I know that you got the consent, but kudos for getting that done. It's not something that we as tax professionals deal with all the time. But nonetheless, good job on that. So this turned out to be very fortunate happenstance. Now, maybe when we copied and pasted the question, maybe it meant to say this turned out to be a very unfortunate happenstance, but unknown at the time, of course, of 2019 tax filing, we would have a global pandemic or an ERTC program based on comparison to 2019. So Matt continues. In comparison of first quarter 2021 to the first quarter of 2019 for gross receipts, according to the income reported to the IRS on Form 1120 of the tax return, this company easily exceeds the 20% decline in gross receipts test for Q1 ERTC eligibility. This is whether the full amount of the other income on line 10 of 1120 is applied to all Q1 2019 or divided by 4 and 25% amount applied to Q1 2019. In either case, it's easily demonstrated that Q1 2021 was more than a 20% less of the total income for Q1 2019. Company is able to file for ERTC Q 2021 as well as Q2 2021 per rules, the look back quarter. So question, what is the allowable allocation of revenue per quarter for 2019 of the other income, line 10, that came from the booking to income of the one-time change in accounting method? does the full amount for 2019 year get tranched to quarter one, 2019 only? Can it be spread evenly, 25% across all of 2019? Or can it be split to the quarters of 2019 in some other method? Can this company find a way to allocate any amount of Q3 2019 in such a way that meets the 20% decline in gross receipts test for Q3 2021 for ERTC eligibility? So Mac, I've got an answer for you. I don't have a solid answer. And what I mean by that is that I don't come across anything yet in the ERTC rules that address that with a taxpayer that has a Form 3115 automatic change going from accrual to cash, here is how you would allocate out the income. Now I have an answer for you on how I would do it for my client. So I'm going to give you an answer, but I'm going to go ahead and refund you the $27 for your question, and only because we don't have anything literally addressing this from the IRS as it relates to ERTC. The rest of the questions that we have things that we can point to. The IRS has addressed it, but on this, the IRS, in my opinion, has not come across anything related to this with the 3115. However, if I was in a circumstance where I go, well, I can't wait for the IRS to address this because I got to report and I got to do this tax return. So how do I go about it? So then a reasonable method comes to mind, of course. And I think it's the third thing is that we're looking at another method, if you will, and picking one that's reasonable. But so, however, my answer is based on what I think or what I would do is you would need to use the new accounting method and apply it to each quarter in 2019. When comparing quarter to quarter from 2021 to 2019, I believe the IRS would expect that although there is a one-line item adjustment to income, the accounting method changed entirely for that tax year, not just at the end of the year or fourth quarter, or as you indicated, first quarter. I don't believe the IRS would see it as a reasonable method to simply divide the adjustment by 4 and then adjust each quarter by the 25%. And the reason why is that, as I understand it, I get that we're making a one-time adjustment. So for those that aren't a tax professional, a Form 3115 is a form that's filed with the IRS to say, hey, I used to be this method of accounting. Now I'm going to use this. Sometimes the IRS says, file it with us. Sometimes the IRS said, you can just do it automatic. You'd always, in my opinion, want to file a Form 3115 so that you can get your statute of limitations filed, if you will. But nonetheless, when you file a Form 3115, and there's lots of reasons to file it, but in this circumstance, this business was reporting on the accrual method. They then moved to the cash method. So when you're an accrual, you are reporting income as it's earned, not when it's collected. You're reporting expenses as well when they're incurred, not when they're actually paid. So it's not even so much, in my opinion, that the IRS would expect the methods to be the same either year. And I think where it would be really weird, and I don't have an answer for this, but if 2019 was accrual, they made the adjustment in 2020, 3115 was filed in 2020, but now we're comparing 2021 to 2019. If you're following, we could have had a circumstance where 19's accrual, 2020's cash, and of course 2021 is cash. I think we'd really be in a quandary there. And I think the IRS would say a reasonable method would be, if you're now cash basis, that you would need to compare to cash basis in 2019. However, the IRS, as we have it now for ERTC, indicates that you go with gross receipts as reported on the tax return. So just that'd be a real quandary. Now, that's not the quandary we're in here with Mac's question. So I'll back up. With Mac, the adjustment was made in 19. So in 19, they went from accrual to cash. And when you do a 3115, this form, you figure out, in essence, one time what was income that was earned in the prior year, but collected in 2019? And then same thing, what would be income that was collected before year end, but earned the next year? And you would then go, well, here's cash basis, so here's what it should be. But some of that income would have been recognized in the prior year, even though collected in 19, because on accrual method, you would recognize it when it was earned. So again, I think when you're filing Form 3115, it's a one adjustment for all intents and purposes, that you though have made an election for that tax year to be cash basis. Therefore, I believe you would need to go back to each quarter and look at what is the cash basis. And the reason I wanted to give you this other scenario is that I don't believe, and I'm not giving you an answer to say, well, because 2021 is cash basis, you must look at 2019 as cash basis. That's not why I'm saying that. What I'm saying is when we look just at 2019, the election is for the entire year. So you would go back and you would look at, okay, well, for quarter one, what was the cash basis income? Quarter two, what was the cash basis income? Quarter three. And then based on that, you would be able to determine if that is down. So that's why I don't think you could put it all in one quarter. And I don't think you could just spread it over all 4 quarters. I think you'd have to actually look at it and go, well, what was it for that quarter? Because again, a change in a method of accounting was for the entire year. And even though the amount is calculated in a total amount on 3115, as well as line 10 of Form 1120, we're definitely, in my opinion, having to look at it quarter to quarter. So again, Mac, thanks for the great question. I feel like I've given you a solid answer. That's 100% how I would do it. I would have no concerns doing it the way that I just indicated to you. I think it's reasonable. I think dividing it by 4 is not reasonable. I think putting it all in one quarter is not reasonable. I think by doing cash basis is reasonable. So I'm happy with my answer, so to speak, but because I'm giving it to you based on experience and I don't have anything to point to related to this, that's why I feel like for you and Mac's the only one that this will occur with, I'd like to go ahead and just give you your 27 back because I don't have anything that we could point to on that. But great question on that. All right, question from Tim. And Tim has additional questions. And so Tim's got additional questions coming later. So Amanda will need to tell Tim there's 2 different times that we're answering his questions. So one of them is right now. And long story short, because of our rush, we just got them a little out of order, Tim. So sorry, you have to go to 2 different spots in the Q&A. But if you're running a cash basis accounting method and you accept credit cards, our transactions you sell goods for as business on June 30 and paid by your customers with a credit card considered Q2 or Q3 revenue as far as the 80% ERTC rule if the funds from credit card transactions are deposited in your account on July 1. So my answer would be Q2, assuming that a credit card was ran June 30. Now, this really moves out of really what is it for ERTC, what we look at, because ERTC says, look to the rules of the basis of accounting that you're using for income tax purposes. So when I go to the cash basis method of accounting, so I'll read my answer. On the cash basis accounting method, the IRS dictates that any income is reported in the period that the taxpayer receives receipt of the income defined as the taxpayer having full access of the funds. Amanda, we're recording, right? Yeah, okay. I think we are.
Yes,
if we're not,
yes, we are.
So while the credit card company creates a delay in the funds being deposited into the customer's account, that would not change the IRS's stance that the taxpayer had full access to those funds at the time the client charged the credit card. The taxpayer elected a third party to collect the credit card funds and then transmit such funds to the taxpayer. This would be similar to a deposit made at a bank after traditional banking hours. and the deposit not being recorded by the bank until the next day. The receipt of check cash is when the taxpayer recognizes the income. That's in the banking circumstances. I don't interpret the receipt of credit card to change this. And this has actually been my stance. Typically we get into this at year end. My stance has been on the flip as an FYI, that if a client charges a credit card on or before 12/31 with the calendar year end, we're writing it off when they charged it, not when the other party technically closed on the transaction, meaning we're not going to base it on, well, the person we paid didn't get it deposited until January 2nd from their credit card company. We aren't going to base it on, well, it's when I pay the credit card company that I get to write it off. When we charge a credit card for a business expenditure under cash basis method of accounting, we get to write it off at the time the card is charged. So it works flip. So again, what it just really comes down to is, I understand from a practicality standpoint that someone charges a credit card and you can say, well, I don't have full access to these funds because it's with the credit card company and I'm not getting my money until July 1st. But from the IRS's standpoint, it's, well, but you chose to collect it with a credit card. You chose to work with a third party that delays from when it's charged to be deposited. It doesn't change the fact that you are the one that received that income. So I believe it falls into quarter two as it relates to your question. So Tim, thanks for that. And again, we have your additional questions coming later. So we got a question from Bob B. We got two questions from Bob. This one is from Bob B. Bob says, I submitted form 3508 for loan forgiveness. Of course, this is for PPP, for all qualified wages for the 24-week time period, which was in excess of $200,000 over the loan forgiveness. I now see we qualify for ERTC for quarter two, which is in part of the 24-week period for PPP. Can I carve out the employees creating the excess and use the ERTC? I believe you said I could. Our loan has already been forgiven. So, Bob, with this, let me read you some technicalities here, and then we'll talk about the answer. So per IRS announcement 122/2021, link in the seminar webpage, also I referenced on slide 144 in the updated seminar PDF. And if you look at any of the SBA instructions to 3508S, 3508EZ, and 3508, the SBA instructions to all PPP loan forgiveness applications indicate, consistent with the IRS, any wages not used for PPP loan forgiveness can be used for ERTC, even if in the same period wages qualify for both. So if you, Bob, if you overreported your wages by $200,000 on your PPP loan forgiveness application, and then you are now allowed to use that amount of wages not needed to achieve full forgiveness for other purposes, including ERTC. So I want to be clear, the way that I read Bob's question is that he, as an example, let's say that his PPP loan was $80,000, but on his PPP loan application, he listed $280,000 of wages. So I interpreting his information here is that he overreported by $200,000. His loan was $80,000, but he showed $280,000 on the PPP loan application. So clearly there was $200,000 of wages, although reported on the PPP loan application, that was not needed, required, or used to achieve full PPP forgiveness. So in these circumstances, then the excess amount, this $200,000, would be able to be used for other purposes, including ERTC. What's interesting here is that with PPP, now you said you filed a form 3508, so there is more information that you provide with a form 3508. There's less information you provide with a form 3508 EZ, and way less information that you provide with a Form 3508S. So the reason I mention all of that is that when you look at any of those, all you're indicating in those applications is here are wages during the covered period that are paid and incurred. You're not actually identifying, if you're coordinating with ERTC, you're not identifying to the SBA, well, these wages, for this employee were in March and April, for example, but for this employee, they were just in March. And for this employee, they were in March and April and May. You're just saying, here's my total payroll. So you would need to go back to your calculation. You would still want to be mindful to carefully go, okay, well, if I only need 80,000 in wages for PPP, I reported 280. Now I'm going to file for ERTC. You would need to meticulously still break out your wages. And of course, you would have the opportunity to break them out any way you want, as long as 80,000 in this example of PPP payroll was used for an 80,000 PPP loan forgiveness. But you'd still need to go through and just be sure that in the covered period for PPP and in the qualifying period for ERTC, that all your wages went together, because for IRS purposes, it is more meticulous. Now, of course, we know for ERTC purposes, we still don't, though, report to the IRS for this employee during this period, these wages is what's included in ERTC. We simply indicate total wages that qualify and total employer paid health insurance that qualifies. So more what I'm getting at is you still want to go through, you're going to need to do your calculations, but I'm not saying this with a wink, wink. What I'm just saying is it's based on what the SBA and the IRS is saying here. Yeah, you can go back. And I think after the fact, you will be able to pick and choose. Where am I taking the wages? So Bob B, what I'm saying in summary is don't look at the 200,000 in excess. What you need to look at is you're just starting all the way over. In my example, if your loan was 80,000 from PPP and you reported 280,000 in wages, giving you a 200,000 excess in my example here, you need to just step back and go, okay, I have 280,000 in wages. What 80,000 went to PPP and what wages are going to ERTC? You would be able to start over. Now, you're not going to be able to go back and change your PPP loan application. Once you achieve forgiveness, it's locked. There's no way to amend it unless literally you discover that you did something wrong. But you would not be able to go back and amend a PPP forgiveness application to say, well, hey, I don't want to include these wages, even though I could. You've deemed 80,000 of wages for PPP purposes in my example, but because you weren't specific, there's no way to be specific. You would be able to go back and pick and choose what wages go for each, but start all the way over. And then even more so, you need to be more meticulous in documenting this, because you already did file for PPP forgiveness. You already did show 280. So upon inquiry from the SBA or the IRS, I think you would want to have true due care that you really meticulously ensured that you still maintain PPP loan forgiveness. And then, of course, you were properly taking wages for ERTC. All right, thanks, Bob. All right, from Cindy, we've got several questions. And appreciate you, Cindy. So question one, are you still documenting the full forgiveness PPP in QuickBooks on the balance sheet only, never on the P&L, correct? So Cindy's been with us a long time. Many of you have as well. So Cindy's going back to YouTube videos I've done on this. And she is a part of our group 51 that a number of you are also a part of, which is just another private group that I visit with on an ongoing basis. So let me preface a little background here. what under current conditions with PPP, on financial statements that are unaudited, management use only, which means we can kind of do it any way we want. It's really what that comes down to. Because what the IRS cares about is how do you report it on a tax return. So if you're doing audited financials, reviewed financials, GAAP financials, this answer doesn't apply to that because you're going to have a different interpretation of what you would want to show on a P&L. So for all intents and purposes, anytime I've presented this, I've made it clear that I'm talking about management use, tax use financials. And so in that regard, what it comes down to is this, JJ, tell us why you're not putting PPP loan forgiveness on the P&L, because we know PPP loan is considered income, but then the law on 1227 made it clear that that is tax exempt income or tax-free income, depending on what your interpretation is. So for me, the PPP is a loan. So probably like every single person here, when the person got the PPP initially, most likely that was initially and immediately booked as a loan on the balance sheet. Now, there was a different way we did it last year before we knew that it was going to be a tax exempt. But even last year and this year, I did not include PPP with my clients' management use financials, meaning we're just using them for internal purposes. I didn't include it on the P&L. And the reason for that is that I didn't want to have a P&L that the management is looking at. And we all know that a bank's going to probably look at these financials as well. But I didn't want the income to include something that's not business income. Now, we all know, especially with small businesses, when they're looking to the prior year, they're going, well, how much did I bring in last year? How much did I bring in the year before? What do I think I'm going to do this year? It would seem like it would throw a lot off if I'm including PPP, even if a separate line item up in the gross income. So anyways, Cindy had complimented me here, which I appreciate. In the January Group 50 seminar, I explained it. Thank you for the compliment beautifully. So what she's verifying, though, is we have it on the balance sheet. Now, how do we get it off, in essence, the liability? So you have it correct here, Cindy, which is the way we worked it, right? It's got to go somewhere, right? We can't just leave PPP on the balance sheet forever. If you so chose, because you just haven't, Cindy, anybody else, if somebody so chose, no, we're going to show PPP on these financials, and we're going to show it as other income. We're going to put it down below. We'll call it PPP. Hopefully everybody will notice, the bank will notice that it's a very specific line item down in other income. Well, what happens when you close out a year for your P&L, right? So if something is included in the P&L, it closes out to equity, partners' capital, retained earnings, in essence, right? It's all going to close out into that. And in essence, on 1/1 of the following year, assuming calendar year end, we're going to see that whatever's on that P&L now is just closed out into the retained earnings or beginning partners' capital. So here's how I've gone about it, okay? So I have set up a line item in equity section, and I've called it PPP adjustment. So I've done this with every one of my clients. So it's a line item in equity, very clear that it's PPP. And then I, as the journal entry, I debit the liability, which basically decreases the liability, but I debit the liability. And then I'm crediting this new equity account called PPP adjustment. And I'm doing it as a separate line item, so it's clear that it's not money that was put in by the owners. And the reason for that is that then the management, and then if they happen to have a third party looking at it, very clearly see, okay, there's there's PPP, that's money that they got. And it's going to happen in the same way. So on 1/1 of the following year, just to take it one step further, Cindy. So on 1/1 of the following year, I'm going to close out that PPP adjustment line item in equity to retained earnings or to partner capital, if you will. So I'm going to close it out. And this is all for book purposes. So because it's a separate line item in the equity section, if we're looking at QuickBooks, we would have to do another journal entry on 1/1 of the following year to get rid of, to close out that line item called PPP adjustment in the equity section. So I would be doing, in essence, I would be debiting the PPP adjustment equity line item, and then I would be crediting on 1/1 the retained earnings or the partner capital. Now, again, this is for management use. So if somebody decided they wanted to just keep PPP as a separate line item, and 50 years from now, we still see PPP as a separate line item in equity, I just feel like from a management purpose only, I know that on a balance sheet that's on a tax return, if the IRS or if the taxpayer is required to do a balance sheet on the tax return, that retained earnings, that partner's capital on Schedule L is going to be after PPP is closed out, whether it's on the P&L or whether it's on the balance sheet from QuickBooks. And so I would rather have QuickBooks or the management purpose only financials, retained earnings, partner capital, match up with Schedule L. Again, it's management use. This is personal preference, how I've gone about it. Now, on the tax return, we would not show PPP as income. If we're talking 1120S, we wouldn't show it as income on page 1 or anywhere on Schedule K. Same thing for 1065. And on 1120, we wouldn't show it anywhere on page 1 as income. Where it would show on a 1065, 1120S, and 1120 is in the M1 section. The M1 section of these tax returns is where you indicate to the IRS, here are differences between how things were booked for book purposes, and here are things that were reported for tax purposes. So section M1, which is on any of these tax returns, and something that immediately follows the balance sheet in the tax return. There's little section M1, and it says book to tax reconciliation, basically. There's a spot that you indicate income recorded on books, not reported as income on the tax return. So I just gave you this long explanation of why I do not show PPP forgiveness on the P&L of my clients for management use only. But on a tax return, we have to remember, now we're talking about a tax return. And I understand that in section M1, it says, well, what did you do on book and what are you doing on tax purposes? Well, the reality of it is that when you're looking at a tax return, there is no spot on a balance sheet on a tax return to show all these little subcategories, or 2 subcategories, if you will, of equity. It's just what is the equity at the close after everything's rolled into it. I also feel that the IRS would want us to disclose the PPP. And so by putting it on Schedule M1, it's disclosing to the IRS that the business, that they received something that could be taxable income, but it's not taxable, and therefore they didn't report it. So the reason for me to put it on M1 is a disclosure to the IRS. So it's bigger than Texas, that, hey, here's an amount that we got, or the business got, that we didn't tax. So statute of limitations start to run, if you will. They want to question it, there's disclosure. Because we can't argue a position to the IRS if we don't disclose it. Now, again, M1 says book to tax. So this would be, in essence, a difference, because when I look at my management use only, my net income does not include PPP. And on the tax return, it says, well, what's your net book income? And it does take into account PPP. The thing is I'm doing management use only. The IRS could care less if their balance sheet and their books or any of that stuff, when it's management use only, match up to a tax return. It's irrelevant. That M1 is more about what did you not report as income, or what are expenses that you didn't deduct, amongst other things such as depreciation adjustments. So on the tax return, I am putting it in Schedule M1. And more, if you get where I'm going here, is that on the balance sheet of a tax return, that PPP, even though included in M1, in essence, closes out to the retained earnings or the partner's capital. And in essence, that amount is the same on the first of the following year. And by making the entry, as I had indicated, to close out the PPP adjustment on the balance sheet to equity or equity, we arrive at the same thing. So minus from a practicality, minus from my clients not getting confused. And we have to remember, even people looking at financials, 2 years from now, 3 years from now. So I don't think there's a right or wrong there. Now, I want to be clear that there is no Schedule M1 on those that file Schedule C or Schedule F. So this is beyond your question, Cindy. But for Schedule C and Schedule F filers, you don't report PPP forgiveness anywhere. It's a completely separate filing from the 1120, 1120S, or the 1065. So Cindy had laid it out, and Cindy, you nailed it in terms of how I've been going about it. Now, question 2 from Cindy, which we appreciate. What is the main reason for not putting on the P&L as non-taxable income? For my clients, I do not want the business income to be either overstated for management purposes, or for anyone looking at the financials to misinterpret such stimulus as business income. So Cindy, I apologize. You asked your question mark, and I should have put in red. For my clients, I do not want the business income to be either overstated for management purposes, or for anyone looking at the financials to misinterpret such stimulus as business income. So I at length went through that on your previous slide, but you had an additional question. My tax man says he wants to do it on 2021 taxes, M1, et cetera, he said, because that is the year it was forgiven. And I'm just saying, Cindy, I have no issues with that. I don't see the IRS would either. And really, when we look at it, the IRS, the reason I don't think they really care is that it doesn't have any effect to taxable income. That's what the IRS is concerned about. Is your taxable income reflected correctly, and therefore you paid the right amount of tax in any given year based on the income recognized during that year. But I would note to anybody, and they go, well, wait a second, if it gets forgiven in 2021, maybe I should report it as an M1 adjustment on a tax return showing that it's non-taxable in 2021. I don't think there's anything wrong with that, as I just indicated. But however, if you remember, the IRS came out with some IRS notices, and then they were superseded in January. So what I'm getting ready to tell you is no longer in play by the IRS. And so you may say, well, then why is it relevant to bring it up? Well, it's relevant to bring it up in that the IRS, in its IRS notices in 2020, indicated that if you got PPP in 2020, regardless of when you get it forgiven, you must report that as a tax adjustment in 2020. That is when the law was you had to make a tax adjustment for it in 2020, whether you showed it as income, which wouldn't be, it would be a reduction of expenses. But the IRS went through many examples. They had 2 IRS notices stating that anybody should reasonably know if they're going to get forgiveness and to what amount, and that if you got it in 2020, even if you file for forgiveness in 21 and you get forgiveness in 21, you are going to report that on a 2020 tax return. Now, again, then the law changed after the IRS came out with those notices, and the law changed to what we know now, which is PPP is not in any way, shape, or form affecting a tax return. It's not income, and it does not reduce down expenses, period. So for me, when I think, well, when should I report this? I go to the superseded, non-existent, the IRS shredded up those IRS notices and said they're void for 2020 because the law changed. So as I was indicating when I was answering Jace's question at the beginning of the Q&A, I looked to, well, it seemed like even though the law got changed, the IRS was making it pretty clear that they wanted 2020 PPP reflected on the 2020 return. So even though the IRS is no longer standing by those notices, there was still a number of things that were addressed in the notice, including, well, when is it reported? Not just how is it reported, but when. So anyways, that's why I just showed it for 2020. I think if you're showing it in 2021, there's not any issue there, but I'm just telling you why I went with 2020 for all of my clients and why I on 2020 got it off even a tax adjustment. So does it really matter from a tax perspective in terms of tax? No. And so for my clients, we just opted to do 2020. I think it results in the same thing. And remember what the IRS, as I indicated earlier, is they want to make sure you're paying tax on the right amount of taxable income in the right year, which also means that penalties are based on tax for the most part. So what is the tax adjustment? Then that's the interest, and the penalties that apply are applied towards whatever the tax adjustment is. And assuming the PPP forgiveness is done properly, there wouldn't be any tax adjustment regardless of what year you reflected it in. All right, so Cindy has another question. We've got it over 2 pages here, 2 slides. Cindy, I changed Cindy's numbers to, she just sent the email to me. I think we told everybody it would be in the seminar, but just in case, I changed the numbers here because we know we've talked about Cindy and being group 51. And so if there's other group 51 members, I don't want anybody to have private information. So all to say the amounts have been changed. So Cindy, all amounts being changed. I received only first draw PPP on 5/4/20 for $85,200. The 24-week covered period ended 10/18/2020. Fully forgiven, awesome, I love it. From the SBA and to the bank, and got a confirmation letter July of 2021. So hired a professional who had done the forgiveness apps for several that were with the bank to help submit. Now, the total payroll in this example that I'm going with is $189,000 for 24 weeks. The non-payroll was roughly $10,600. So non-payroll being rent, utilities, and interest that qualify under PPP. So Cindy did a form 3508S, which is for those that have PPP 150,000 or less. Because the application asked the amount of loans spent on payroll costs and not what was the total payroll expense, she put only the full loan amount of 85,000 under the payroll cost and not the total payroll expense, and did not use the non-payroll expense of 10,600 anywhere. She said, since they simplified it, we don't need to worry about the non-payroll. Plus, then I had more than enough payroll to be able to also use for the ERTC later, if revenue goes down Q3 or Q4 in 2021. So what I'm going to break down here is, so the question was, well, what is the payroll? So I'm now going very basic, not to get too basic, but I'm getting very basic. And the reason I'm breaking it all the way out is we know that the actual payroll, of course, is $189,000. So that's really what we're starting with here. So what I want to know is, well, what would be required to achieve full forgiveness for PPP? Well, the loan of $85,200 at 60%, only $51,120 would be required to achieve full forgiveness. Now, that would assume that the PPP loan was spent 40% on the non-payroll, which is rent, utilities, and interest. So if you had reported the $10,600 of non-payroll, you would need to report, though, $74,600 as payroll for full PPP forgiveness purposes originally. But because the 10,600 non-payroll items were not reported, you would then have to allocate the 85,200 for PPP forgiveness purposes, and the excess would be available for other purposes because any excess, of course, not required for PPP forgiveness purposes could be used for ERTC. So what I wanted to be clear on is when anybody's filling out a Form 3508S, when they're doing that form, it says what was the amount of payroll spent on, what was the amount of the PPP loan spent on payroll? Well, if you list at least 60%, the SBA would assume that the other 40% was on non-payroll. Now, of course, we know we can't just do that. We need to actually be able to stand by. If we only show a 60% amount for payroll, we would need to actually have the rest in rent, utilities, and interest. But I want to further note here for Cindy's Form 3508S, if she chose to only reflect on the PPP loan forgiveness application, only the amount of payroll that was needed to achieve full forgiveness, she would have listed 74,600. That is above the 60% that's required. So I know that when we look at it, and I know it's simplicity, and in the end of the day, it's like, well, it may not matter at all. Maybe it won't. But at the end of the day, when you look at a Form 3508S, it says, what is the PPP loan amount? For this example, it's 85,200. Then it says over in the far right, what is the amount you're requesting for forgiveness? And it would be, if you had all the correct expenses, 85,200. And then it says in the left, so you're not doing this electronically, what was the amount spent on payroll? Now, knee jerk is you would say, well, I better show 85,200 or they're not going to forgive all this. When in reality, all that needs to be listed there is 51,120. Now, don't get me wrong. If you had plenty of payroll and you put 85,200 as your payroll cost, that's the amount of your PPP loan. You just made it easier and you fly through. All I wanted to point out is for Cindy, because the loan was 85,200 and she had 10,600, if she had put on the PPP loan application 74,600, she would have achieved full forgiveness. If the SBA said, well, you only listed that, so did you have the other expenses? And Cindy said yes, and they said, okay, well, you need to provide them, and then the SBA approved it, she would get full forgiveness. But because the professional that worked with Cindy, and I don't think it's going to turn out to be detrimental, but because the professional working with Cindy said, we don't need to include that, what I'm more wanting to be clear on here is that because rent, utilities, and interest was not on the PPP loan, it now is irrelevant. By the amount of payroll costs that is listed on a PPP loan forgiveness application, that amount, to the extent that is required, absent any other information, is the amount that was then used for PPP loan forgiveness purposes. Stated another way, because 85,200 were listed as payroll, and then no other information was provided related to the non-payroll expense, then in fact 85,200 was used for PPP purposes. Now let me be clear, on Form 3508S, there is no spot to put non-payroll costs. There's no spot like Form 3508EZ and 3508S. There's no spot to list rent, utilities, and interest, because on those other two forms, there is a spot to list them. So how in the world would we tell the SBA that we had those other expenses? Well, in Cindy's example, the way that you would only use what was required to achieve full PPP forgiveness is to report the amount net of your other non-payroll costs. And another way to state this is that you do not get to go back to a PPP loan forgiveness application where you just showed your payroll cost equal to the PPP loan and didn't reduce that amount, you don't now get to go back and say, oh, well, I had rent, utilities, and interest, so I now don't have to use all that payroll even below the amount. That would be false, because the SBA didn't consider, take into account, presented, or have the opportunity to question your other non-payroll expenses. So Cindy, I'm going beyond a little bit of your question on that. So Cindy continued on by saying, after seeing the ERTC live seminar and just looked at the PowerPoint again, now before I submit this, my concern now is, did we not do it right? And I say, and I'm assuming you're getting ready to submit ERTC and you're wanting to know if you are submitting things correctly. And so I say, you did it A-OK, in my opinion, as in the PPP loan forgiveness application. Should I do anything or just leave alone? So other than the potential loss of not using the non-payroll costs on the PPP loan application, I don't see any other concern. You are not able to amend the PPP loan forgiveness application for a PPP loan that has already been forgiven, unless you literally found a gross, like an error. Cindy continues, and on top of that, I am eligible for Q3, Q4, if revenue 2021 Q3 or Q4 is 20% decline, of course, compared to Qs similar in 2019, since my payroll costs were way more than needed for full forgiven. And so I indicate you can use wages in excess of the PPP loan forgiveness for ERTC, but only in a period, of course, qualifying for ERTC. So Cindy, I'm going back a slide to just say, of the 189,000 that you have, 85,200 you have in fact used for PPP loan forgiveness purposes. Now, if you didn't listen to the earlier part of the Q&A, slide back, because I talk in detail about what I'm getting ready to say to you, and part of the answer is that you now have to just start all over. And I don't mean that in a detriment, but you kind of have to start over, because you have 189,000. It was during the 24 weeks. You know, during that 24 weeks, you've used 85,200 now for PPP purposes. But you now have to go back and go, well, what payroll am I using? Which employees? So that you can then identify what payroll you're using for ERTC, which of course is potentially falling outside of your 24 weeks. So all to say, many may think, not necessarily you, Cindy, but many may think, oh, well, I have 189,000, I used 85, so I got roughly 104,000 to work with. Yes, but you still have to now define both periods of time. You're now going to have to go back and do the work to determine what wages am I using for PPP and what wages am I using for ERTC. It will not be acceptable to the IRS to only show the calculation of ERTC. It will not be acceptable, because what the IRS says is you can only use wages not used for PPP. So if you've already filed for PPP loan forgiveness, you now need to go through the steps to identify what you used for PPP, to then demonstrate that the wages that you do have in excess of that do qualify for ERTC. So don't get me wrong, it was not a bad thing to do what was done. Many have done it, but now that you have ERTC, you need to go through the steps of both to identify, not just a simple, I have an extra 104,000 to work with, because that 104,000 extra to work with is only during the 24 weeks. That doesn't necessarily mean that that's 104,000 used for ERTC, except in the rare circumstances it probably doesn't exist for anyone, that their time of qualifying for ERTC is the exact 24 weeks of their covered period. So Cindy says, or because we did not deduct the 10,600 in non and put it all under payroll cost, does that automatically disqualify for the ERTC either way? So not reflecting the 10,600 doesn't disqualify you from ERTC. I believe it disqualifies the use to the decrease of payroll needed for PPP loan forgiven, not I'm sorry, because it was not recorded with the original PPP forgiveness application and thus not approved by the SBA as proper or not. So at the end of the day, yeah, you'll be able to get your ERTC, and as long as you're not using 85,200 of payroll during that 24 weeks for ERTC purposes, you should be in really good shape there. So Cindy, thanks so much for the questions. I really appreciate it. All right, we got a question from Bob S. This is the other Bob, Bob S. So we sell computerized point of sale systems only to restaurants. Most of our customers have their indoor dining rooms and bars closed per state government mandate. At the height of the closure, less than 35% of our customers remained open for takeout or delivery. So we kept our on-site service department open as it was essential to those restaurants being open. However, our sales and training departments were non-essential and revenue in these areas plummeted and were partially suspended. Both the sales and training departments, though, were not less than 10% of total gross receipts and the number of hours not less than 10% of total compared to any quarter in 2019. So I wanted to break out for you, Bob, here, that when you're talking about the 10%, so as a reference, you know, Bob and everyone in here that took the seminar has the reference that when we're talking about the 10% rule, and I'm going out on a limb assuming the 10% rule you're talking about is whether or not a portion of the business that's non-essential can, in essence, be enough to consider the entire business reduction, due to government shutdown, qualify for ERTC. So let me state it another way. When you look at IRS Notice 2021-20, I believe, if not 2021-23, what the IRS indicates and made clear for us is that if you have a business and that business is made up of essential businesses or services or products, so you have an essential portion of the business and a non-essential portion of the business. The IRS indicates that if the non-essential portion of the business is affected by a shutdown, then the entire business can qualify. All employees can qualify for ERTC. The IRS gives an example in the IRS notice of a hospital that also has a pharmacy. This hospital and pharmacy is all one company. And in the example, the hospital is essential and the pharmacy is not essential. And if the pharmacy's gross revenues is 10% or more of the overall revenues of this combined business, then if there's an effect on the non-essential portion of the business, then the entire business is considered affected. That's a direct example from the IRS. So now put some numbers to it. Let's just assume that the entire business, which is the hospital and the pharmacy, does $1 million. Okay? So it does $1 million. And the pharmacy gross revenue is $150,000. So the $150,000 is 15% of the overall gross receipts of that business. Therefore, if the non-essential portion of the business is affected, then the entire business is affected. And all of the employees, whether essential or non-essential, can be included in the ERTC. Now, let me be clear. In 2020, if they're over 100 employees based on 19, if in 2021 they're over 500 employees based on 2019, then all employees can be included, but only wages paid to employees that didn't provide services are wages that can be included. So I want to be clear that we do get to include all employees. If it's 500 or less in 2021, if it's 100 or less in 2020, then all wages to all employees would be able to be included in this example. Now let's go back to Bob's question though specifically, and I just wanted to indicate that the 10% that you're talking about you would not compare the gross receipts simply of the sales and training department to 2019, meaning the 10% is not anything to do with comparing to the 2019. This 10% rule is looking at, okay, what's the gross of the entire business? How much of that comes from non-essential? So when you're considering non-essential and essential, and does it affect the whole business, there's no comparisons to a prior year. So as it relates to the 10% test, I believe you're referring to, that is, if the gross receipts of the sales and training department were 10% or more of the overall gross receipts of the business, then that is enough to dictate the effect of a department deemed essential versus non-essential, and then everything would qualify. Of course, you have to meet all the other qualifications. And again, we're talking about governmental shutdown, governmental effect here, okay? Not talking about when gross receipts are down. So that's part of why I wanted to point this out. When you're in a governmental shutdown, you're not comparing gross receipts to 2019. So Bob continues, Bob S. Furthermore, our team, sales, and training department employees cannot cross some state lines per state government mandate in order to provide on-site service or deliver parts for out-of-state customers. Therefore, we cannot provide on-site service or parts to these customers. In your opinion, do we qualify for ERTC? And I say yes. So I want you to hear why. Yes, because of the travel mandate. Now let's be clear. And I know Bob is not doing this, but for anybody else listening to this answer, I'm not talking about wink, wink, let's smirk, and oh yeah, you know, our travel, oh golly, we couldn't travel. Okay. But the CARES Act indicates specifically that if travel is affected or affects the business, then they qualify for ERTC if they're under an official governmental mandate order, if you will, to be shut down, partially shut down, or affects their business. Now, let me be clear. The IRS, let's note this, the IRS does not qualify a business for ERTC based on the pandemic's effect on customers of said business. So what I want to be clear is you don't qualify because your clients, which are in the restaurant industry, were affected. That doesn't qualify you. The IRS is very clear. So all of your restaurants could have even closed. They could have been completely out. They're open 35. The IRS goes, you know what? That doesn't qualify you for ERTC. So that's not why you qualify. Also, okay, separately, unless your local or state government deemed any of your business as essential, I would not consider your business essential in the ERTC sense of the word, as keeping your clients open wouldn't make you make your business essential. Now, don't get me wrong. I understand in the real world, okay, you were essential to that restaurant staying open, okay? Meaning that restaurant was relying on you. So I'm not taking away from the fact of how important you and your company is to your customers. But we're putting that aside because that's not how the IRS is determining essential and non-essential. And what the IRS relies on is, what does your local and state government deem as an essential business? I don't think that what you've described to me would create you to be an essential business. Now, I understand you could make this whole argument that you're essential, okay? But here's what I want you to know. Not being an essential business would work in your favor, okay, as the 10% test has no bearing. So you don't need to argue you were an essential business. Honestly, arguing you're an essential business doesn't help you, okay? Being a non-essential business is an easier hurdle to get over. Now, the IRS does make it clear there are non-essential businesses that will not qualify for ERTC. So simply being a non-essential business doesn't qualify. All I'm saying is this 10% test that you referenced only comes into play if you are considered an essential business and you have a non-essential portion of your business. All I'm saying is I don't see your business as essential unless your local or state government has said you are an essential business. Then this 10% test comes into play. But again, the 10% test is not comparing anything to 2019 on the 10% test, okay? Comparing to 2019 has nothing to do with business closure. Comparing to 2019 would only be qualifying for the employee retention tax credit if your gross revenues were down. And let me take it one step further. When you are looking, I'm going beyond your question, Bob, here, but when you're now relying on the gross receipts test for ERTC purposes, there is nothing and no bearing on essential and non-essential. No bearing. Your gross receipts are down, essential or not, part essential, part not, no relevance when we're talking about gross receipts being down. You're talking about a governmental shutdown, the 10% test that does come into play, and I know I'm repeating myself, has nothing to do with comparing to 19. What it has to do is looking at the total receipts of the business and how much is from the non-essential. And if it's 10% or more, if there's a disruption to the non-essential, then it's enough to disrupt the entire business, and then all of the business would qualify. So let me back up. The reason I feel you qualify is because of the travel mandate, plain and simple. Plain and simple. All the other things that you listed out besides the travel aspect don't come into play. Okay, doesn't help or hurt you. Meaning your customers being affected doesn't help you. Okay, you saying you're essential or non, that doesn't have any play in your business. I don't think, like, it's irrelevant unless your governmental agency said you're essential. The 10% test then is not a factor here. So again, I go back, and I don't think you are, Bob, but I want to make clear to anybody else listening to this answer. If you're not, if you're a business and you don't normally travel, or you travel one time out of state or twice, and you're not really a business that has to do business out of state, okay, then travel doesn't come into play for you, in my opinion. Me saying, oh, I got clients in other states, and gee golly, I couldn't travel to them, wouldn't qualify me, in my opinion, based on the travel aspect, to be one of the ways to qualify for ERTC. So based on what you're telling me, that there's a travel mandate, it disallowed you to go. So I understand you're doing other things that normally you don't have to go out of state. Would you look at a reasonableness here? Probably. Meaning, if you had zero effect to your revenue, and you go, yeah, we normally travel all the time, but we weren't allowed to travel. But you found another way to do business, your gross revenue really didn't change, maybe you made a little more, lost a few customers, gained a few customers. You know, it'd be maybe hard to argue to the IRS that travel mandate really had an effect on your business. So the IRS does say it's based on facts and circumstances. They probably look at, well, what state mandate, was there? Was it really a state mandate, or was it an airline mandate? So you want to be making sure you're under a state mandate. All right, Bob, great question. And for me, assuming that travel is, an integral part and routine, and that definitely had an effect. Now, you are indicating that, sales plummeted. So I'm assuming that you did, even though you're not relying on the sales based on this question here. So thanks again, Bob. All right, we got a question from Rodolfo. Probably didn't pronounce it right, so I apologize. So my wife is a sole proprietor for a wedding photography business for Japanese tourists in Hawaii. That sounds great. She is the professional photographer with no employees. Can she treat herself as her own employee and apply for ERTC? And/or can she treat me as an employee when she uses me as a translator? She is Japanese and speaks little English. So I'm going to just lay out the rules, and then I'm going to talk further about it. So here's the dry rules. The IRS makes it clear without exception, self-employed filers, that's Schedule C and Schedule F, are not eligible for ERTC. That income is not considered wages. ERTC requires wages. So to be clear, I know throughout PPP, which has nothing to do here with ERTC, but throughout PPP, self-employed filers somehow got it in their head that they have payroll to themselves. They do not. You know, someone could be self-employed and they go, oh, but every Friday I write myself a check for payroll. They could say, oh, no, you know, the PPP said I had payroll. Wrong. Self-employed per the SBA, and even more clear, per the IRS, directly in the instructions of Schedule C, indicate that a self-employed individual cannot pay themselves wages. And if they so chose to pay themselves wages, they can't deduct it. So if somebody goes off the deep end and pays themselves wages, the IRS goes, you're not going to be able to deduct it. So the point is that it's very clear that the self-employed have self-employed income and it's not wages. That's why the self-employed on their amount of net income is not able to be in the ERTC. Furthermore, in IRS Notice 2021-49, the IRS was specific to indicate that the self-employed do not get to include their self-employed earnings as qualifying for the ERTC. Now, the second question. So a self-employed person can employ their spouse without any issue. So the IRS has rules related to it, how you go about it. So a Schedule C filer, Schedule F filer, can hire their spouse and pay them a wage, W-2, and deduct it, and the spouse is going to pick that up as wages. Why would they do that? Well, lots of reasons. Health insurance or health insurance plan, HSA, you know, the spouse having Social Security wages, the spouse being able to participate in a retirement plan, lots of reasons that you would do that. Now let's talk about ERTC though. Because the self-employed owns 100% of the business, that's by default, the spouse is automatically, for ERTC purposes, also considered a 100% owner under IRC 267C4. This means the spouse is a related party and their wages would not be eligible for ERTC. So here in the next set of questions, Carol is asking some questions about the owners. But right here, what I'm going to note is that this code section 267C4 basically says this, okay, that for ERTC purposes with spouses, okay, if this spouse is a 52% owner of a business, okay, the other spouse that has nothing to do with the business, never shows up, doesn't know where it's located, doesn't get wages from it, doesn't know who works there, has zero interest in it, owns nothing of it. But for ERTC purposes under code section 267C, that spouse is also considered a 52% owner, meaning whatever this spouse is an owner, this other spouse is considered the exact same percentage. So with the self-employed individual, they're 100% owner. So the spouse, for ERTC purposes, is also considered a 100% business owner. So let me be clear on this. Let's say somebody says, yeah, but I filed a Schedule C, but I'm a single member LLC. Well, that's just a legal designation. That doesn't change anything with how you file Schedule C or Schedule F. It doesn't change any of this. Now, I know there's some that may say, well, wait a second, we have an LLC and I own 50% and my spouse owns 50%. Well, the IRS then requires you to file a partnership return. Long story short, nothing's going to change this except the one exception that's also under section 267C4. I'm going to read it to you and then I'll tell it to you in layman's terms. So the exception is if the majority owner, and if there's a marital spouse, and there is in this example, have no brother or sister, whether whole or half-blooded, ancestor or lineal descendant, as defined under 267C4 of the code, the wages to the spouse qualify. This does not change the fact, though, that the self-employed income still does not qualify for ERTC. So in layman's terms, right? So if you're taking the position that you meet the exception, then you really need to meet the exception. But instead of spending a lot of time figuring out if you meet the exception, what does that mean in layman's terms, this exception? So if the majority owner, which in this example, they have a majority owner, it's 100% owner, and the spouse, so both of these individuals here, okay, marital spouse, no brother, no sister, whether whole or half, ancestor, lineal descent. What does that mean? It would mean that in essence, you have no living relatives. You can come up with all these examples. You know, well, what if I have a cousin and they live in another country? It doesn't define anything about citizenship. And the only reason I'm mentioning that is because you're talking about Japanese tourists, and then based on that your wife doesn't speak, or speaks a little English. So I'm only bringing that up because this would be any brother or sister, not just U.S. citizens. And now I'm not saying you both aren't U.S. citizens. I'm just trying to give you the most complete answer that I possibly can. But it also doesn't mean you can go wink, wink. And I don't mean you, but I'm talking about for anybody else listening in. Oh, well, no, that they're not. I mean, when you hear ancestor, lineal descent, okay, we're talking about the line. I mean, if you got family living, now there's some exceptions even to that, but I'm not going to go into those exceptions because they're way out, okay? They're way out there. So if you're trying to find the exception to this, okay, and you got relatives, you're probably not going to find the exception. But if you have no relatives, okay, like related to you, either one of you, okay, you're not going to qualify. And part of what I interpret with brother, sister, half-blooded, ancestry, lineal, okay, is that they are talking about, blood and how we're related. So there are specifics where a stepbrother or somebody that you're living with or things to that effect, well, those aren't blood or half-blood or any kind of blood relatives. So we're talking about that. So again, if you're wanting to find the exception, anybody listening in here, I think it's going to be hard. It'll be far-fetched, and you really then need to get into 267C4. Based on what you told me, if you have no relatives, either one of you, then yes, your wages could qualify for ERTC. So at the end of the day, assuming you do have relatives, I don't see that your wages would qualify, but there is an exception to that. So thank you so much for the question. Sorry, we don't have a better answer in the sense of being able to qualify there, but I do want to mention for you, as well as any other self-employed individual, that for the self-employed, now this has nothing to do with ERTC, but if the self-employed had COVID, was caring for somebody with COVID, or had the symptoms of COVID and quarantined themselves, or was told to quarantine even if they didn't have a medical test saying they had the coronavirus, but if they have cared for, or they have had it, they've quarantined themselves or cared for somebody that's been quarantined or told to quarantine by a medical professional, there is the tax credits for the self-employed under the Family First Coronavirus Response Act. And what you'd want to look at is Form 7202. And it has the instructions that go along with it. And you're able to get a credit on, in essence, a portion of the net income from that Schedule C. And so there's two ways to qualify. I don't want to go into too much detail other than to say that if you or your spouse, either one of you, were affected personally by COVID or caring for, in all those examples, there is a credit that you can qualify for. And especially if you are paying yourself wages. Now, you can't go back retro and pay yourself wages during the time that you were sick in terms of the spouse asking if they could pay themselves wages. This would be on a go forward. And then that credit ends September 30. And then there's a 10-day max. There's a 50-day max, et cetera, depending on what you're qualifying for. But all of those days that have a max, that resets on April 1st. So I'm giving you an additional area where there could be a credit available. The next thing that you would probably want to look at here is potentially, should you, instead of filing a Schedule C, nothing to do with ERTC or this other credit, but you may want to talk to your tax advisor, depending on the amount of net income of your wife's business, whether it would make sense to tax yourselves as, or tax her business as an S corporation. So there's things to it. I've got videos on it that you can find, but you might consider that based on the net income. So just a little planning point for y'all to consider. And what it does is saves you self-employment tax. There's going to be wages expected to be paid to your wife from the S corp. And so then potentially what you're saving is a little bit of self-employment tax. So at the end of the day, just a couple of planning points for you as well. So thanks for the question. All right, so we've got 6 questions from Carol. So Carol is said, so far I've opted to use the 941X for ERTC because Intuit, which is a tax software, is just behind the 8 ball on getting the 7200s turned around on time. I've completed all the 2020 941Xs for anyone that qualified and have just started the 2021 year. So the seminar was a good refresher, plus additional defining of the gray area. So I'm saying thank you for that, Carol. Owner, spouse, relative, qualified wages. I think we could all benefit from a layman's explanation, and I know I would. So Carol's second question dives into this. So I'm going to go to the next slide in a minute to really expand on the layman's explanation. But remember, if family, whether employed by the company or not, whether owners of the company or not, meaning family, collectively own more than 50% of the company, they are related parties. And any wages paid by the business to any of these individuals would not qualify under 267C4. Now, the exception is, and I know that some are not listening to every answer, so I am going to repeat what I just stated in the prior answer, but the exception is under the same code section is that if the majority owner and if the marital spouse collectively or each other, marital majority owner, have no brother or sister, whether whole or half-blooded, ancestor or lineal descent as defined under code section 267C4 of the code, then the wages to the spouse would qualify as well as the owner, okay? And I'm going to go into some layman terms about that as well. Now, if I filed some for 2020 with wages included, should I let it be? And I'm interpreting that there were some 2020 941s or 941Xs that were filed that included owner or spouse's wages. So I would amend the returns to remove such wages. However, when the penalty letter comes, I'd rely on the IRS notice on waiving such penalties, which I think was in 2021-49. And the fact of the matter is that it was clear, as evidenced by the AICPA inquiring on whether or not owners and spouses did qualify. So if you were to amend the returns, and of course there'll be a repayment of the credit, therefore there would be probably the computer at the IRS automatically assessing penalties and interest, writing a letter and relying on the IRS's announcement, their notice, that in these circumstances, due to reasonable cause, that you would not need to pay penalties and interest on that. And I included it in my tax update as well. But nonetheless, I'm going to go to the next slide that expands on the owner, spouse, relative, layman discussion or layman explanation. So question 2, explain constructive ownership, okay? So look at it this way, what we want to clear away sometimes to understand some complexity of the law. And I know that I want to be confident, or I'm confident knowing who Carol is, really probably has a great grasp of this. And so I think for the benefit of both of these questions, It's also for the benefit of our audience. And, Carol's a great supporter of the YouTube channel since the beginning and helps even take care of people that have questions on the YouTube channel. So with Carol asking for the layman's and then also what's constructive ownership, I'm going to break it down. So Carol, no, I'm not breaking it down this simple for you. I'm breaking it down for everybody as requested. When we are coming across a complex part of the law, sometimes we got to wipe away things that are probably easily confusing us. Not necessarily Carol, but just confuse us related to it, including me. So when we look at constructive ownership, what we have to remember is we're not initially caring what family owns the business initially, okay? Initially. What we're just trying to define first here is there any other family and who are they, okay? So we got a husband and a wife, okay? Are their parents alive? Are their brothers and sisters alive? Half-blooded, full-blooded? Are their kids alive? Do they, there's this full list of all of these different family members. I mean, the IRS is exhaustive in listing every kind, including step kiddos, if you will, stepmother. There's even an example that if somebody, their principal place to live is the same as the majority owner. I mean, it's extensive. So you just have to first look. And so if you were to go, well, here's somebody that doesn't have any living relatives. Their parents aren't here. They don't have any. And the reason I even bring this up is that I actually now have a client that's in that circumstances. I was at the funeral of their brother this morning, and I was at the funeral of their other brother a few years ago, and I was at the funeral of their mom and their dad. And this particular individual that's last standing for this family is literally last standing. Okay. Both parents were only children. He doesn't have any children. He's not married, but even if he was, we'd have to look at the spouse. But all I'm telling you is that I actually have a client that when he looks around, I hate to say, he has no family. And I hate to say it, yesterday, another client of mine died and he has zero family. None. Zip zero. Now he's no longer with us, but these circumstances do arise. But if somebody is standing there and they can find family, doesn't matter if they live in the same state, doesn't matter if they're involved in the business, that they own it, doesn't matter if they have wages. So once we kind of look at that and we go, okay, we haven't even talked about wages. We haven't even talked about ownership yet. We're just looking at it and going, do they got family? Yes, no, yes, then let's put it over there. Now what you look at is what family owns the business. It doesn't matter what family, but what family does own it, okay? And what it really comes down to is if you take a group of family members and just one of them owns the business and it's more than 50%, which means that they are a majority owner, then everyone in that family is considered a majority owner. Everyone. Doesn't matter if they get paid by the business, doesn't matter if they work in the business, doesn't matter if they never even talk to them anymore. They're not even on terms to talk anymore. Okay. What that means is that all of those relatives constructively for ERTC purposes under Code Section 267C4 also have a majority interest in that business. No, it doesn't mean they own it. No, it doesn't mean they could inherit it. Doesn't mean they have control of it. It means nothing. All it means is that under Code Section 267C4, any of those family members, even if just one of them's a majority owner, then every single one of them, when you look at them, they're a majority owner. You're a majority owner. So now what we look at is then the wages. Okay. Then we look at the wages. So I'm going to continue with the example, and the IRS has nice 4 examples in their IRS Notice 2021-49, which you have a link, and I did provide those in the original seminar. Now what you're looking at is wages. And now all we're trying to figure out is, well, do these wages qualify for ERTC? And the fact of the matter is then any wages paid to any of these family members, because there's one family member that is a majority owner, and every single one of these family members now for ERTC purposes is considered a majority owner, then none of the wages to any of these individuals, the owner and the spouse, all of these related individuals do not qualify for ERTC purposes. Next, though, we're going to take one step back, because you said, well, JJ, you said one owns 52%, okay? And therefore, everybody is 52% owner, ERTC purposes, which then also means anybody getting wages is not going to qualify. Now let's go with the example of you have two family members that own the business, but each into themselves, they're not a majority owner. So one of them owns 20% and the other family owns 30%, okay? Well, right now, what we would normally think is, okay, well, for those two people, collectively, constructively, to constructive ownership here, collectively 30%. I forgot what percentages I said. I apologize. So I'm gonna go with percentage. I don't know if this is what I said or not, but I'm gonna go with 30% and 25%. Okay. One of the family owns 30%, the other owns 25%. Collectively, they own 55%. So logically, we think, oh, okay, well, these two own 55%. So constructive ownership is that collectively they own 55%, 30% and 25%. And logically, we think, okay, well, then maybe to both of them, their wages don't count, because collectively they own 55%, making them more than a 50% owner. But now we got to go one step back to what we already talked about. Okay. Any other family member, okay, to these two that are family members that collectively own 55%, here's what constructive ownership means for ERTC purposes. The one person that owns 30% for ERTC purposes under Code Section 267C4, they're actually constructively a 55% owner. The other owner that only owns the 25%, though, for these purposes, constructively owns 55%. And any other family member that's a 0% owner, each of them constructively are considered a 55% owner. Therefore, none of the wages to this group are going to qualify. Now, the IRS even gives this example to really drive it home. You have a dad, of course, then you have, in their example, it was a dad and a son, okay? The IRS tells us, because we're talking about ERTC, okay? The son doesn't own the business, the son's not involved in the business, the son gets no wages from the business. So to help us maybe visualize this, the son lives in another state, the son doesn't come work in the business, the son does nothing for the business, the son knows nothing of the business, the son gets no wages. Like, really think, like, the son has nothing to do with the business in any way, shape, or form, okay? In their example, they talk about, here's a 100% owner, okay? And they're the only two members of their family, like no other family exists. Because the dad is 100% owner and has, though, a living relative under 267C4, collectively, there's 100%. And you may think, well, duh, He's 100% owner. He's 100% owner. What's the son have to do with it? He's not involved in the business. But the IRS says under 267C4, if you're 100% owner, but you have these other relatives, you then don't qualify. And therefore, the wages of that dad don't qualify for ERTC. I know it's a scratch our head, but that's directly from the IRS. Now, what would make that dad qualify? Well, under terrible circumstances, right? There is no son, or he just didn't have any kids. And when he looks around, there are no relatives. Then that 100% owner under 267C4 would qualify. So what you have to look at is any family anywhere ruins it for ERTC purposes in determining majority ownership. Now, let's go the other extreme. You have someone and they own 49% of the business. Forget, they own 50% of the business, okay? They own 50% of the business and they have relatives out the yin-yang, okay? All the relatives work for the business, all of them, every single one of them. It's just a mooch business, okay? They own 50%. The other 50% owner, okay, not related to them in any way, shape, or form, not related, okay? That is a 50% owner. They're not a majority owner. Their wages qualify. All of the family that gets paid qualifies, okay? Let me tell you what everybody then goes to. Oh, okay, well, if they're 50% and their spouse is 50%, no one's a majority owner. Wrong. Under 267C4, spouse and spouse, each of them are deemed 100%, and every family member you look at is deemed 100% owner, which is majority ownership. Now no one qualifies. That's why there's a very, very slim margin here of those that would meet the exception. So constructive ownership is looking at any family member, adding it up, but to really drive it home, whatever that percentage of collective or constructive ownership is, every family member you look at has that amount also as their constructive ownership. And I'm just repeating myself, but even the person that has one relative in that example, and even though they don't have anything to do with the business, the son in essence disqualifies due to Code Section 267C4 from the dad's wages qualifying for the ERTC. All right, in the third question, so slide 43, can you explain the Social Security versus Medicare tax differences from 2020 to 2021? And is this why we would need to wait to file 941X for 2021 QT filing? So I wouldn't wait to file QT. I wouldn't wait to file Q2. I'm going to expand on this, and I'm going to include slide 43 for our reference. And Medicare is only for Q3 and Q4. So of course you would want the 941 that would correlate with that. If you're going to file a form, and Carol would already know this, but anybody listening in. So if we roll to the future, we're in December of 2021, January of 2022. And now you're looking to amend some 941Xs in 2021. You would need to use 941X as we know it for first and second quarter. And then you would use the new Form 941X that hasn't been released as of right now for third and fourth quarter. And why? Well, let's go to slide 43. Okay, so this is out of IRS Notice 2021-49 that the third and fourth quarter of 2021 that the ERTC will be applied against Medicare payroll taxes. So for previous to this, the ERTC applied against employer Social Security payroll taxes. So Form 941, 941X would include the calculation changes, most notably on Worksheet 1. What's Worksheet 1? Worksheet 1 is when you're completing a 941 or 941X, you're indicating here are the ERTC wages. Here is the ERTC employer paid health insurance. Collectively, if you will, here's the amount that qualifies, and then here's the credit. So in 2021, it's 70%, and in 2020, it's 50%. So when you figure out the credit on worksheet 1, it also then helps you break out, well, how much of that credit is applied towards Social Security, employer portion of taxes, and then anything above that is in essence refundable. Now it sounds weird to go, well, wait a second, you're telling me that some of the credit is non-refundable and some of the credit is refundable? What I'm telling you is that on a 941, 941X, you're breaking it out really for the IRS internal purposes, if you will. In some ways, I don't even know why the IRS technically needs that included, because it technically can just be automatically calculated. Now, it makes sense that it is, but when you're breaking out then on the actual form, it says, well, of your credit, what is non-refundable and then what is refundable. If you paid all of your payroll taxes, Carol knows this, I'm just saying in benefit of everybody. If you paid all your payroll taxes, in essence, you overpaid because you didn't have to pay all those payroll taxes, because you didn't have to pay in the employer portion of Social Security tax, at least to the extent of the ERTC. But if you paid it all in, that non-refundable portion does actually become refundable. You just got to go through the form, which obviously, Carol, I know you have many, many times. So with that being said, that's why I don't think you need to wait for second quarter, obviously, because it's still on Social Security. And then on third and fourth, it'll be Medicare. And I don't know if 941X, the new one they come out, will have something in there that says, if you're filing for third and fourth, use this worksheet 1. If you're filing before then, use this worksheet, or if it'll be, if you're filing for third and fourth, you need to use this 941X. If you're filing before then, you need to use this 941X. So we'll have to see, but I'd go ahead and, if you got them, and put them in there. Now, the rest of the slide doesn't tie to the question, so I'm just going to go through the rest. I'm just clicking through. You can go back to slide 43, anybody. Question 4 from Carol. So slide 46, which I'm going to put in here. This is new. I have been including tips as all forms are tracked on payroll and cash tips are not tracked separately. At one point in time, credit cards became more popular to limit the spread of COVID. Again, I did not exclude tips in any Form 941s I filed, but I kept detailed records if there's an issue later on. So in a nutshell, and notice 2021-49, what the IRS clarified was that the only tips that can be included in ERTC wages are those tips that are collected in cash. Why? Well, we know that the IRS wants to know about tips that were collected in cash so that there can be employer taxes on that as well as employee taxes on that, not to mention the federal and state tax that would apply to that. So they want to ensure that employers continue to have an incentive to report cash tips. And so the incentive is, well, if you report the cash tips, then we will include that, or you can include that in your ERTC qualified wages. We know that when we look at IRS Notice 21-49, again, this is slide 46 from the seminar, just in general, okay? Excluded from wages, okay, page 22 of the notice, is tips paid in any medium other than cash. If tips were not paid, if tips were paid not in cash, it is not includable in the ERTC wages. So notice 2021-49 came out just a couple of weeks ago. So we're talking, mid-August here. This is new information in terms of that notice. Included in qualified wages, page 22, tips $20 or more paid in cash as reported by wages by the employer. So the wages do have to be reported by the employer, but the amount of $20 or more are included. An employer can take advantage of both ERTC and the tip tax credit under section 45B. This is talked about in pages 22 through 24. Again, these page numbers here are to IRS Notice 2021-49. These wages can be used for both tax credits. Let me go back. What's Section 45B? Well, it's the tip tax credit that's been around for a long time, which is if an employer reports tips in these circumstances, the amount that they pay in employer payroll taxes, they are able to get a tip tax credit on that, meaning, okay, well, I know you had to pay these payroll taxes, but we'll give you this credit and offset. So I'm not going through that detail. Just note this: if you're working with restaurants, obviously Carol is, but if you're working with restaurants, hopefully you're taking advantage of the tip tax credit. If you are a restaurant, hopefully you're taking advantage of the tip tax credit. But 2021-49 makes it clear that you can use wages for the tip tax credit, meaning these tips, and you can use them for ERTC, so you can benefit from the same $20 or more paid in cash. Now, I'll tell you this, I don't believe that I did address it in seminar 1 or 2, because the IRS, as far as I know, hadn't addressed it directly, but I actually concluded previously that no tips were included in ERTC, none. And that was after some research into somebody that had emailed me a question, a restaurant owner. And the research that I based it on was just simply that excluded from wages was tips. And so I was like, well, makes sense. And in fact, before 2021-49, I had a video to restaurant owners. I've since taken it down. But I had a video to restaurant owners and said, hey, you don't get to include any tips because it's not wages you paid. It's money from a customer. That's why you don't get to include it for ERTC purposes. So I actually made an assumption no tips were included based on my deep dive research. Obviously, once the IRS came out with Notice 21-49, we do get to include in qualified wages, tips paid, $20 or more in cash. Everything else is not. So Carol, based on your other question, I'll assume potentially if you filed and you have some tips that were included and they're not the cash, meaning they were paid by credit card or check, obviously you know that. And that's why Carol in the previous slide had said, you know, people paying restaurants on credit card like went on the rise, partly because they were probably you know, restaurants for a period of time and other businesses weren't accepting cash. We know that especially with takeout and delivery and all that good stuff, well, that's by credit card. So that's what Carol was referring to, is that there obviously would have been an increase to that. So the IRS is in essence making it very clear in these pages that even that is the truth, or that is the case, that only cash is going to be included. And I actually see it as the IRS is making an exception that the cash is included. Because again, my research before that was like, no tips are included because it wasn't a wage paid by the employer. So anything that's going back and being corrected, again, it wouldn't affect the tip tax credit under Section 45B, of course. But if there's any tax due or repayment and there's penalties and interest, then relying on the IRS, hopefully their announcement or in their IRS notice that they'll waive the penalties related to this seems reasonable. And I've had 2 circumstances, just as a side note, at least last year on 9/41, where the client took the Family First Coronavirus Response Act related to the sick leave, and we weren't clear on it and the dates, and so a deposit was reduced, and then we realized it was a carryover and blah, 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 blah. All that means is that their 9/41 for first and second quarter were off, and how the payments were made were off, even though the tax overall got paid properly, and then the credit was ultimately able to be taken, et cetera, et cetera. And so anyways, the IRS, of course, just doing normal generation or generating of IRS notice just included penalties and interest, even though the net sum of that was no tax was due. And we just named the IRS's notice related to this, and it did waive both of them. It just required the letter. So the only crapper on that is that the tax would need to be repaid. And then the tax professionals and CPAs and EAs, I'm not going to go into further discussion on this, but we all do know the rules related to our requirement or our client or requirement to amend returns. So you can make decisions based on that. I'm not going to go any further into that, but for tax professionals and EAs and CPAs, you can draw your own conclusion on requirements related to amended returns. So question 5 from Carol. Slide 56 refers to incurred. Slide 72 refers to paid. All I was noting, and it was a 4-hour seminar, but I did note that as I was presenting the seminar, I said, oh, this says paid. I probably should say incurred to make sure that it's clear. So what I'm noting to you is I believe when I uploaded the new one, I updated that. Now I'll double check slide 72 because I know I updated in 2 places to say incurred. And that was because during the seminar, I was like, oh, this is going to be kind of confusing if I say paid here. I better say incurred. So I went back and updated it and then re-uploaded with a few other minor typo adjustments. So long story short, to me, it's still about being incurred. Paid would be when reported, but incurred in terms of what's included. So I'm going to use this as an opportunity to just sum up, what wages get included in ERTC, what was incurred during the qualified period. When do wages get reported for ERTC purposes on Form 941? When they're paid. Question 6, slide 79. You're recommending that 941X be processed with a carry credit forward. To date, I've been choosing refund simply of the situation with Intuit, the tax software. I can switch to carry credit forward, but I'm curious if these are submitted as a credit forward and the 941s are already filed by the payroll service. Would you still suggest a credit carryover if you cannot get 941X filed in time, or stick with asking for a refund? So Carol, on that, yeah, I know I covered it earlier, but you may have not been tuning in. You probably were, but maybe you weren't tuning in. I digress. When I did seminar 1 and 2, I said, hey, mark it for refund, boom, get your money back. Of course, we know now in August, going into September, the IRS, understandably so, is very behind and is not been able to send out very many checks, if any, that I'm not aware of. And so the strategy that I came up with clients that were having to go back and amend payroll forms for 2021 or going to amend, I was thinking, well, gosh, if we have this delay in actually getting the check and the refund, then we should go ahead and issue a carry credit forward. So Carol, if you look at the instructions in 941X, they do get into, and you might even already be familiar with this, but for anybody else, they do get into in the instructions in 941X that if you're filing a 941X and it's for a period way back, the first quarter of this year, and here we're now in third quarter. So if you are amending first quarter 2021, you've already filed second quarter of 2021, 941, but you're getting ready to file a 941X, that you would take that credit on your third quarter Form 941. You wouldn't need to amend Form 941 second quarter. You would just simply take your carryover credit on your third quarter Form 941. So when you go to look at reporting the credit carryover, so if you look at Form 941X, they actually give some nice examples of what they're talking about. Now, they do give rule of thumb of how close to a 941 being filed you should file a 941X. And unless, I would probably say if you're filing a 941X like here on August 30th or 31st or the 1st, and you weren't filing a Form 941 for third quarter till near the end of October when it's due, that if you're reading the 941X instructions, that seems to kind of fall in their time period of at least file it by this period of time. And what they talk about is within no more than within 30 days of when a 941 is filed. So if you were fast forward, we're all in, let's say it's October 10th, and you're filing a 941X for first quarter, and you're getting ready to file a 941 for third quarter, what the IRS is saying is, if you file a 941X, in this example here in October, and you're going to file a 941 in October, we ain't going to know about it. And then most likely you're creating a rat's nest where the IRS is going to say, when you file a form 941 for third quarter, hey, where's this credit? We don't know this credit. Now you owe this tax. And here's penalties and here's interest. So obviously, if somebody is in those circumstances in October, I would recommend that you would file a 941X for first quarter after you file form 941 for third quarter, and then file it on the fourth quarter. I'll just say it again. If you're filing first quarter 941X and you have it ready to go in October and you haven't filed form 941 for third quarter, I would not file a 941X until after third quarter 941 was filed. Then I would file 941X and I would take that credit carryover on fourth quarter 941, because if you filed a first quarter form 941X after you filed third quarter 941, and let's say in early November, that gives the IRS hopefully enough time to digest and report that information so that when you file fourth quarter 941 for 2021, that credit would be in the system and the IRS would recognize it, and therefore the credit would reduce down that tax in fourth quarter. Now, the thing to remember that I didn't talk about in the seminar is that if you're asking for a carryover credit forward, of course, then you would want to reduce down the payroll taxes that you're paying in whatever future quarter you're going to report that on, that actual 941. So gosh, so much to that. Hopefully that was helpful and made sense. And again, the Form 941X instructions, for anybody that doesn't do payroll normally and that's making your head spin, look at the 941X instructions about that. I think they do a good job really laying that out for you, and then just go by that. Thanks, Carol, for the 6 questions. All right, we got a question from Chris. So cardiologists had mandated closure. They were unable to do elective hospital procedures from March through some of April. They did not get PPP till late April. The elective procedures were about 8% of the total receipts. Since this is a nominal amount, less than 10%, that was not allowed. Does that mean they cannot claim ERTC for that period based on the partial shutdown rules? So I have a simple answer here. I'm going to give a longer one, but if the other procedures continued, I don't believe they qualify, meaning if only their elective procedures couldn't continue and their elective procedures are less than 10%, then you would be in a position where they wouldn't qualify, of course. But if they were not able to do other procedures, then I would say yes. And the way I looked at it with my doctors is, so like in Oklahoma, dentists couldn't do elective, but they could only do emergency. Well, without a wink, wink, and a smirk, the interpretation, according to the ADA and as well as the Oklahoma Dental Association, is that all dental services are considered elective. Emergency would be more about the patient's pain, so to speak. So for dentists, it was like, well, you can't do elective, you can do the other. So we didn't even look at percentages. I mean, what we looked at was, this is a clear effect. So I didn't look at the back. Now, of course, I'm talking about a business that we deemed as pretty much all elective. But, I had a client that also is a brain surgeon. And he was not able to do quote unquote elective surgeries. He was able to do, life threatening. Well, he really didn't end up doing anything. And so maybe look a little closer at, well, what's the definition of elective versus non-elective? And of course, that's different state to state. The way it was interpreted here in Oklahoma, not even beyond me, was like in the brain surgeon, you think, oh, well, that's essential. They weren't able to do elective, but actually really most any surgery is elective. Now, if that brain surgeon had decided that he determined that all his surgeries were essential because he's an emergency doc, and of course everything coming in and he works on is life-threatening, then of course he's in essence deemed himself essential in that regard. So with cardiologists, I know that you're based on elective procedures, but what else is really elective in what they do? So you might be able to more, and not even in a clever sense, but more in a methodical sense, include more in what is really considered elective. I would assume, it's elective for just a checkup. It's elective for, the patients that come in and are like, man, I'm having chest pains. Well, that visit's just a consult, or, well, how'd you do after the, how did you do after the surgery? So I get it. Cardiologists are going to probably make their bread and butter mainly, on their surgeries, if you will. But there's probably also a ton of revenue out there that really is elective or non-essential, so to speak. So hopefully that helps from there. Question 2 from Chris. So we're talking about the Family First Coronavirus Response Act, sick leave and child care leave. Where do we report it on the return? And then I'm going to skip. And the other question is, well, where do we report ERTC? So if you go to the instructions for any tax form, Schedule C, Schedule F, 1120, 1120S, 1065, and where you would look at is the instructions for the line item for taxes as a ordinary deduction. So wherever the instructions are, when you that any of these forms I just said, when you go to, and it'll be in bold, obviously Chris knows this, but for those that are listening in on this answer, when you're going through the instructions of any of those forms, there's going to be a section that says taxes, and taxes that they're talking about in what I'm referring to is the deduction of taxes, the line item as deduction of taxes. Obviously, Chris knows this. But anyways, in those instructions is where we find consistently that the IRS indicates that the Family First Coronavirus Act is considered other income. So whatever that credit is, it is recorded as other income. And then for ERTC, in that same instructions, it indicates that ERTC is a reduction of wages. And as a side note, Chris, they do indicate it's a reduction of wages in the line items that they list, both 1120 and 1120S. It's clear that it's owner and other salaries because it references both lines. I think they're different line items for 1120 than 1120S. So my interpretation of that is that if there was a Family First Coronavirus Response Act, technically on any wages that would go in the officer comp line, then it would reduce down that amount. And if it was on others, it would reduce down the second line item. You know as well as I do, it all nets to the same. But whether it's considered other income or reduction of wages, for those that aren't a tax professional, the net effect is the same. Income to your bottom line increases the bottom line. A reduction in expenses increases your bottom line. So they both have a tax effect, but they clearly indicate that Family First Coronavirus Response Act, you consider it gross income, you put in a line item for that. And then the employee retention tax credit is a reduction of wages on the tax return. And then I'm just going to add for the benefit of everybody. But we know in IRS Notice 2021-49, and it was the most shocking news to me, that they would expect these to be reported on 2020 if it's wages that were paid or incurred in 2020. So that's where the IRS talks about incurred. Now, hang on, let me back up. 2021-49 only addresses ERTC. It doesn't address the Family First Coronavirus Response Act in terms of what year. I would assume they would expect it to be consistent. The IRS also indicated that if you didn't report it as a reduction, that you need to amend your return. Now, as tax professionals, we know what are the true requirements of amending. We know that if it's a nominal amount, is it prudent to just correct the next year? You can make your own decision as tax professionals, of course. Keep that in mind. I think that does come into materiality, especially if you have an S corp or partnership and then it flows to the individual or multiple individuals. I think there's a reasonableness there, especially given that the IRS just came out with this. So any returns, of course, that we're filing on or after notice 2021-49, we've been put on notice of what year we have to report this. Again, 2020, then it's in 2020. And what I find interesting in 2021-49, when it references paid or incurred, basically what I think they're making clear in that, and that's for income tax purposes, not the calculation of the employee retention tax credit. What it's talking about there is that if you incurred wages in 2020, even if you paid them in 2021, those wages that were incurred in 2020, that adjustment goes to 2020, right? So when we talk, and Chris, this isn't directed towards you, I'm just expanding on your question. So when we go all the way back to several questions that we've had is, well, JJ, the law and the code says when wages are paid. And I'm saying, well, my interpretation of paid means not when a check is cut to the employee. When you look at the overall ERTC, what it's making clear is wages paid in the qualifying period, as in, here's what was paid to that employee that day, not that they got a check that day. So I'm not going to repeat much of what I just spent a lot of time earlier. So you can go back if you just skip to here, those beyond Chris. But when you look at IRS notice 2021-49, what they're making clear is that paid or incurred for income tax purposes, you don't get to get away with, oh, well, I paid those wages in first quarter of 2021. So I don't have to make an adjustment to 2020, even though that payroll at the beginning of 2021 included wages from 2020. The IRS is indicating is if it was incurred in 2020, you're making your adjustment for wages that resulted in a credit, even if those wages were paid in the next year. And that's how I continue to stand by the wages that determine the employee retention tax credit are based on when they are incurred, because the IRS goes out of its way to say, hey, listen, the adjustment you're going to make for income tax purposes, if it's incurred or paid. Okay, so if it's incurred, you're going to include it. All right, thanks, Chris. All right, question one from Tim. Now, Tim had asked us a question, and just due to the timing and with what was going on today, his question was included earlier. So here's his additional questions. So if a restaurant is on cash basis accounting, where will sales that occurred in Q2, so June 30, but were deposited in Q3, July 1, count for ERTC calculations of the 80%? Could be credit card deposits for the same sales in previous days, then the quarter overlaps and some other orders. So for Tim, I gave that answer previously, and I think we emailed Tim, and long story short, Tim, I think, was repeating this question, but we have a new question below. So if you want the full answer to this, Tim, you already listened to the first answer. That answers it here. For those of you that didn't pay attention to Tim's first question earlier, then if you're watching the video back or when the video gets uploaded, go back into this video, go find the slide where I say question from Tim, and I give you the answer to his question. But in a nutshell, it's this: when that customer pays with a credit card, the date that that's charged would be the quarter that falls into, the same as if there's a check or cash received by the business from a customer, regardless of when that's deposited in the bank, that is deemed as income when received. The credit card being swiped doesn't change that. Now, the second question, would moving from cash basis accounting system to an accrual basis accounting in 2021 disqualify you from getting ERTC in 2021? So that in itself does not qualify for ERTC. I've not come across anything to say, well, then how would you go about it? We had a question earlier, several questions. I believe it was from Jace. No, it was from Mac. And it was similar but different. And in that, there was an accounting change. So a form 3115. The only reason I bring it up is that if somebody went from cash to accrual, then whatever year it was put into play, it would be deemed that the entire year was that new method. In the question that came from Mac, the accounting change was made in 19. You're comparing 21 to 19. My best answer to him was, well, then you would go back and recalculate the 19 gross receipts on the method that it was elected to be in 19, but do it quarter by quarter. I'm not finding anywhere that the IRS would require a matching method. I think that it's reasonable they would require a matching method. What I mean by that is that if you were accrual in 2021, that it would be reasonable for the IRS to expect that you would come up with, well, what's the accrual method in 2019? But there is, as I know, there's not anything directly on that. So then we go by, well, what's a reasonable method? But simply having a different accounting system in itself would not disqualify someone for ERTC. All right, for question 2 from Tim. What if we as a business owner interpret our state's governor's order incorrectly about a governmental partial closure of a restaurant? There has been some fighting between the governor and the state Supreme Court that is making it very confusing. And then let's say we interpret the order as a partial shutdown, but later the IRS says it is not. So I'm going to add some things to this, but IRS states whether there is a shutdown or not is based on the governmental order. Meaning the IRS doesn't determine anything. What they say is, was there a governmental order? Yes or no? Then if there was, then you're under a governmental order. Now the IRS does go out of their way to really talk about, well, what's a valid governmental order? I'll continue. At this time, it appears the IRS will not override a governmental order, meaning if the governmental order qualifies, it qualifies. The IRS has recognized that governmental orders may be presented differently based on state laws, but that it must be a governmental agency making an order, not an announcement or a recommendation. IRS further states it can be a local government, meaning county or city, for example, and not just the state government. So Tim, in this, I would say, I would look at what you did at the time. What did you actually do? And then I say, please listen to further details. So I understand, and obviously I'm not going to be intimately aware of the situation that you're talking about, but if at the time the governor has an order, and at the time it is deemed to be a valid order, and at the time you follow that, what was meant, what was known to be a valid order, you follow it, you do it, you shut down, okay, or partially shut down, or if it was a reduction you talked about a restaurant in the previous slide. So if we're still talking about a restaurant, and it's, you have to reduce down occupancy by 50% or whatever. So if you follow that order, to me, you would qualify during that period of time if that's what you actually did. So let me be clear. If at the time a business said, well, I don't think the government's order is valid and we ain't shutting down, or they just disregard the order, then I don't think you qualify for ERTC. If it's disregarded, or You say, I don't think it's valid, and I'm not shutting down. My actions are, I'm not following the order. Then I don't think you qualify, even if later you go, oh, shoot, I guess I should have, because I now want to qualify for ERTC. And I understand, Tim, you're not going that route, but I'm trying to give a complete answer for everybody. So if later a Supreme Court comes out and says, well, that governor's order wasn't valid, I get it that now in August or after the fact that the Supreme Court may say, yeah, that wasn't a valid order at the time. Well, guess what? The IRS is going to look at what was in place at the time. The Supreme Court overriding, and I don't remember the state, but I believe really more now what's in play between the Supreme Court and the governor would be what's going on right now, even though it quote unquote technically would be retroactive. And also typically when matters like this come about between the state government and now you have a Supreme Court getting involved to interpret something, typically the reasonings for that is then for all future circumstances, because what it was is what it was. And I think in this regard that the state governor may ultimately be deemed that it wasn't a valid order or something wasn't valid. But the purpose of that really in going to the Supreme Court would be more on the ongoing. So all I'm saying to you, Tim, is if you follow the governmental order, and it was a governmental order, and in my opinion, okay, I understand the Supreme Court in the state is going to potentially say that was not a valid order. But what I'm telling you is at the time, a reasonable business owner would follow a governor's order. And then if that business followed that governor's order, and it was an order, not a suggestion, not an announcement, not a press conference, but like an order, it was signed by the governor. To me, you qualified during that period of time. And I would argue it to tooth and nail that you would qualify, even if after the fact, the state government or the state Supreme Court said, no, that wasn't a valid order. I think it then comes down to facts and circumstances, and a reasonable person would follow a governmental order. Let me go one step further, Tim. Let's just say, for instance, the governmental order has been in existence since the beginning. And from the beginning, restaurants can only have, 75% capacity or 15% capacity. And that order has been in play the entire time and has never changed. And from the beginning of the pandemic or when that order was put into play, you have not been able to have full capacity if we're talking about a restaurant. And then it is determined by the state Supreme Court that that's not a valid order. Then in my opinion, when you would then stop qualifying would be when the state Supreme Court said it's an invalid order. Then as of that date, even if the Supreme Court said it was retroactive, my conclusion would be, okay, well, as of that date, it's not a valid order, and we now don't have to follow that governmental order, even if it's for that entire period of time. So if the Supreme Court reverses something or says it's not an order, I would look at it as, well, from that date forward, anything the governor said that we had to do, we're not going to be required to do it, and therefore you wouldn't continue to qualify because there would be no governmental order in play at that time. So would we pay a penalty on the ERTC received for the periods that were interpreted wrong? Yes, but that would assume you interpreted it wrong, meaning you would assume, or you would have to be telling me, well, JJ, we appreciate everything you just went through, but we really think that that order was invalid from the beginning and we were dumb to shut down. That was ridiculous. We should have known better. That was ridiculous for us to do that. Okay, well then you're going to make a decision that you don't qualify. Okay. But what I'm telling you is everything I just told you. But let's just say, for instance, you lose, you argue it. I can't imagine you would lose. But let's say you do. So how bad could these penalties be? Well, payroll penalties can be extreme in extreme cases. For sure, there would be a late payment penalty and interest, and based on the amount, additional penalties, because there's gross negligence. And so based on too many variables and the number of potential penalties possible, I don't have an official amount. Here's what I tell clients, though, on a payroll issue like this, and what I told clients when I said to them, we're not taking your wages as 100% owner or majority owner. We're not taking your wages into the ERTC until the IRS assures me that we could. So, but what I did tell the clients was, listen, we're not going to take the credit, because if we can get it, we can get the money later. But if we take the credit and we have to pay it back, we could be looking at, around 25%. So, 5% late payment, 5% underpayment, 5%, you had to correct it, and then you have interest. And I just usually round up for other tax professionals when clients say, well, what's the penalty? I'm like, it's up to 25%, right? You got at least 3 5% penalties in there. You got interest in there, and then round it up. So I would say, you might, probably looking at 25%. It could be possibly 50%, because if your ERTC credit is, 150,000 or 400,000 or $1 million, because there is no limit on it. Well, that's a gross, overstatement of a credit. So there could be a 25% penalty on that. And so you could be looking at 50%. And then if the IRS was like, whoa, you took $1 million credit and you only had 2 employees and you didn't even have these real wages. Well, then there's constructive fraud. So it could be 100% and more. You can have 100% penalty plus all the other penalties plus the interest. And so, Tim, I'm not trying to scare you on the penalties. It's just that there is no answer to that, because it depends on the facts and circumstances and how severe and the dollar amount and how long and facts and circumstances. Now, for you in these circumstances, I'd probably tell a client, well, if something goes wrong, then you're going to owe, 25% in penalties and interest, probably on the high side. If it's a huge credit, you may have a 25% underpayment penalty, so to speak, for a huge amount, like maybe. And so you might be looking at 50%. And so what you can do is wait if you want it. And the fact of the matter is, we know from Form 941X and the instructions that you have 2 years to file a Form 941X. So we have time. So you could wait and see what's the Supreme Court say. You could wait for your state CPA society to probably weigh in, because you wouldn't be the only one trying to figure this out. A lot of times the IRS will weigh in sometimes on state issues like this. But I really feel strongly that when you look at what the IRS says about a governmental order, at the base of it is there needs to be a valid order that's required to be followed, that the government is instilling. And at the time, that was a governmental order and it required you to take action, and you took that action, then I think that you qualify. But if you want to play it safe, you can give it a little more time, because you do have time, and then you'd have more information. All right, so third question from Tim. And we're on slide 33. We end at slide 38. Question number 3 from Tim. If we had an existing business going back to 2010 and then bought a second business on September 30th, 2021, could we go back and combine the sales of the 2 businesses to look at the 80% ERTC for the first 3 quarters of 2021 and or for the 2024-2020? So for any qualifying period, the IRS would require, under aggregation rules, that you aggregate the gross receipts. If you were to qualify for ERTC after the purchase, so after September 30, you qualified for ERTC under aggregation rules, you would need to combine the sales for 2021. And then when looking back, if the business that you bought existed in 2019, you would need to look at the sales in 2019, combine the sales back then with the existing business that's been around since 2010. If the business did not exist in 2019, meaning the second business that was bought, you would need to look to the rules of how to determine the correlating sales in place of the 2019 amounts. That would not make the existing company, the company before the purchase, able to look to another period if it were in business in 19. So the first thing we look at is that the IRS has addressed these rules, and what they've indicated is that if somebody buys a business, it's in 2021 33, and that's the revenue procedure, because the revenue procedure addresses gross receipts. And then 2021-49, I believe, also has a section about gross receipts. I'm sure that it does. And then, of course, there's discussion of gross receipts. But the IRS recently identified these circumstances. So let's break this down really quick. So the first thing I want to look at is you have the new business that you bought. Scratch the word new. You have a business that was bought on September 30. It's the second business. So here on out, I'm going to call it the second business. If that second business was in business for all of 19, then for fourth quarter 2021, assuming that one of those businesses qualified for ERTC, then you would take the combined gross sales of both businesses in fourth quarter 2021, and you would compare those to the correlating fourth quarter 2019 and determine if there was a decrease. Now we know there's an alternative rule that you can compare third quarter 2021 to third quarter 2019, and if that's down at least 20%, then you can also, under those guidelines, qualify for fourth quarter. So if you have a business that you bought, the IRS allows, and under aggregation, I believe will require, that you would be looking at then, well, what are the third quarter gross sales of the business that was bought? What are the gross sales of the third quarter 2019 of the second business, and determine if there's a 20% drop. And then if yes, that could qualify for fourth quarter as well. Now, your second question is, or hang on a second. The IRS also addresses that if the second company wasn't in business in 19, so let's say the second company was only in business in 2020, what the IRS dictates pretty nicely is that for that second business, you would look to 2020 in determining your gross sales comparisons. But if you are with the second company and you're using 2020 for its comparisons because the second company wasn't in business in 19, that has zero effect on what you're comparing with the existing company. So the existing company is still going to compare to 19, even if the second company is using 2020. Hopefully that makes sense there. And then you would go, well, in place of 19, this is what the second company has to include, then that's what you would aggregate together with whatever the correlating amount that would have to be included for the existing company. So the second question, if you buy any business today, can you go back to 2020 and 2021? And if they qualify for ERTC for shutdown or loss of sale, can you claim the untaken ERTC? Only if you purchase the business itself, as in bought the shares, units, etc., meaning if you bought the EIN, if you will, kind of layman term of that. So if you have a business, right? Now let's just for a second, let's take who owns it and you bought a second one and blah, blah, blah. Take that out of the equation, okay? Take it out of the equation because it's the business that qualifies, okay? It's not the owners that qualify for ERTC. And I'm not even talking about their wages. What I'm talking about here is it's the business that qualifies for ERTC for the wages that the business paid, okay? So that business at any time, regardless of who owns it, can go back and get a tax credit on the wages that are paid at that time. So if that business, it's just continuing along, it's the same EIN, right? It's just the same employees, it's the same EIN. Even if there's a change in ownership, it doesn't change the fact that that company can go back and get a credit on ERTC wages. So yes, if the ownership changes over, that business, if it still can look back and qualify, can take it. To take it another step further and is if you only bought the assets of the business. And I'm going to be clear, I'm not telling you a technicality to find here because there is no technicality. But if you bought the assets of the business, meaning you bought the name, you bought the client list, you bought the phone numbers, you bought the vendors, you bought contracts, you bought the furniture in the building, and then all those employees, every single one of them, all now are working for the new company, meaning you have a second business that you set up. Here's the key word. You have a second business that you set up and it bought all the assets of another business. No, you would not be able to look back. So even though, for all intensive purposes, this second business is nothing but a continuation of the other business. Well, it's not, because that business that sold is no longer in business, or more to the point, you wouldn't have control of any existing continuation of a business that you didn't buy. So let me just back it up. And really, in layman's terms, it's if you bought an EIN and you're controlling now that EIN, then you get to benefit from anything that would qualify. Now, you also are then responsible related to PPP. You're responsible if the ERTC was taken incorrectly, because it's the business that's really being looked at. The owners may experience the economic effect of it, but it's really the business that we would be looking at. So hopefully that helps with that. So thanks for the third question. We got a fourth question from Tim. Question 4, I understand ERTC is not when you pay your employees, but it is for the day they worked. It's the same for the governmental shutdown and the same for the loss of sales ERTC, same for either qualifying period. Meaning when you look at the ERTC and we walk through the steps, the first thing is, well, do we have a valid business? Yes. Okay. Do we have a valid employer? Yes, meaning has employees. Then we look at, well, do they have a qualifying period? And the qualified period is governmental effect or loss of sales. Yes, we have a qualifying period. Then whatever wages qualify in the qualified period is what can be used in the ERTC. That's why there are no different rules on what wages get included when you're looking at the qualified period. So no matter how they qualify for it, you're going to do the same in terms of determining what wages you will include. And then in the case that it is for the days they worked, are you saying we have to dissect each day, even in the middle of a pay period? And my answer is you would dissect each day, even in the middle of the pay period. So the examples I'm going to provide here are what was already in the seminar. So this is not new. Okay. So in the section of the seminar where it's the slide is black and you see a calculator and it says in red ERTC 2020, and then the same thing, it's the same calculator, but it says ERTC 2021. In those sections, that's where this is. Also, you have examples of this as well as Excel spreadsheets that are on the website. So when we're talking about the 2020 employee retention tax credit, I'm not going to go through this complete calculation, but here's how we went about it, Tim, is with our own clients, is we looked at, and this kind of came from like our first ERTC calculation, so to speak. But we just looked at it and we're like, okay, look, Sam and Sally, Roger, Lucy, Wayne, and Lisa. Okay. What's their hourly pay? And how many hours did they get paid during the time? And this is 168 days. This is a time period that qualified. These are then the work days, of course. Okay. So how many hours were they paid for? And I understand the word says paid, but an employee got paid for that day during the period, regardless of when they actually got the money, right? So hourly pay for Sam was 13 hours. Well, Sam worked 168 hours. So the total pay that we're including is that. So I didn't worry about, well, we have this partial pay period and then that partial pay period. What I looked at is for an hourly employee, what is their rate? And of course, if the rate changed, then we'd have to have a second line item for Sam to go, well, Sam worked this many hours. So I simplified this. And quite frankly, in this example, some of these are hourly people and some of them are salary, because we all know you can take a salaried employee, divide it by 2,080 hours, which that's 52 weeks at 40 hours. And you'd come up with an hourly rate. Any salaried person, you can come up with an hourly rate. And it's not, well, that they worked 10 hours that day, or no, they may have worked 10 hours, but what they get paid for that day? They got paid for by that amount. So what we found is for our salary, the ones that were salaried and the ones that were hourly, we go, well, what's their hourly rate? And then how many days were in this work days, were in this period? And for this, everybody was working the same number of hours. So how many hours are there? And then what's the total pay? So this is how we solve. And we've had zero headaches, at least for me. I've had zero headaches trying to figure out this pay because of this method. Now, there's a second method that you can go through. Now, this is for 2020. Okay. This is in the seminar, so I'm speeding through it. I already went through this with you. Now for 2020, right, this is the same thing, right? I just showed you this calculation. This is also for 2020, but we all know there's many ways to skin a cat, as they say in Oklahoma and probably Texas. So 2020 employee retention tax credit calculation. Here's another way to calculate it, okay? What's the total eligible wages during the qualified time? So I can tell you this right now, we actually just figured out a tax credit, and basically it was a 10 days. Okay, it's 10 days, 10 working days. It was 10 working days that we got to include. And what I told Alona, who helps really prepare most of these, I said, Alona, we don't care if it was in 2 pay periods. It doesn't even matter because we know it's in 2 pay periods. What does that matter? What matters is, what do these salaried people make in a week? Okay, that's 5 days, 5 work days. Well, so what do they make in 2 weeks? And technically with this particular client, they're a bi-weekly employer, meaning they pay bi-weekly. So I said, Alona, this is simple. Every pay period they have is for 10 people. Now I understand we could find 600 ways to complicate the calculation, but we start out with a simple method. So if there's somebody hourly and then they're part-time, or somebody works some days and not other days, yeah, you bet there's going to probably be some line items here that are more confusing or have to have more information. I get it. But what I told Alona is I said, listen, just look at a pay period. We know they didn't get a raise. That pay period is for 10 business days. We know that they're going to get a credit for 10 business days. What is that in a payroll period? Put it down, 1,600, 5,960. Now, that's also different in this is that I figured out the credit per employee. It's just another way to skin the cat. But we can, frustrate the circumstances to go, okay, well, there was this period, but then there was 4 days from this period, and then there was 3 days in that period. And that's probably us, with all due respect, having fun with it and enjoying being overwhelmed. And I'm being facetious, but I tell my clients that, I tease them. I'm like, you're just trying to make this complicated because it's exciting when it's complicated. I even tell my staff or clients or friends, I'm like, you just like being confused, don't you? You just enjoy it. Because when we say we're confused and when we say something's hard, then guess what it is? Confusing and hard. This isn't confusing and it's not hard. What you're figuring out is how many work days are there in a period that qualifies for ERTC, what's their daily pay or what's their hourly pay? Or in a circumstance like this, like, well, what's just their pay? It doesn't matter that it was 2 pay periods. So we're not out going, well, wait a second. Let's see, these 5 days were in that pay period, but then these 5 days were in that other pay period. Oh my gosh. And then guess what? Now it's reporting in 941 next quarter. Hopefully, you know I'm having fun here. What we look at is, here's a qualifying period. What do they get paid? Throw it in there. Right? And don't get me wrong, this is not a hand grenade and horseshoe calculation. That is right and exact and perfect and to the penny, because that's all that matters, right? We have 10 days. What does that person make? Now you're right. If they have an employee and one day they work 6 hours and the next 4 and the next 9, well, with that employee, what I would do is go, well, what's their hourly rate? And then how many hours did they work in those 10 days? Got to be pretty simple, right? Payroll records have to be, in my opinion, they're straightforward, right? There's no employer that says, man, I don't know what my employees get paid. I have no clue how they ever get paid. I don't know when they get paid. I don't know how that's calculated. Gee, God, you don't. There's no way, or at least there's somebody knowing. So all you're doing is breaking it down. That's why I included these examples, because it's just like, break it down to the easiest common denominator, figure out either the hours or the pay period in time. Now, I included here, just for fun, I included 2021, but it's the exact same concept for 2021. And the only reason I included 2021 is to say there is no difference in any way, shape, or form. The difference in 2021 is it's a 70% credit. Also, the difference is that it's quarter by quarter, when 2020 is an annual limit on wages, but it's the same calculation. And as you can tell, 100% of my clients I've been working with forever, which means that at least 15 years. I don't have any clients now that I haven't worked with for at least 15 years. So I can give them a hard time, but better yet, I just tell my clients, like, hey, you qualified for ERTC. We already calculated it. Here's the credit. Here's your 7,200, sign it, fax it in. You're going to get a check. And or, oh, your payroll company didn't do it, so we calculate it. Here's the wages. Here's the information for 941X. Get it filed in. But I digress just to say that let's not be confused about the calculation. Let's not pretend that it's hard, because technically it really isn't. And when we're talking about the amount of money that can come back, we need to, and I'm not at all saying, Tim or anybody else that's listening in, I'm not at all saying that you're complaining, because you're clearly wanting to get it right. You're clearly want to make sure you're getting the ERTC. You don't want to do something wrong. And at the end of the day, what I'll say in closing, because this is our last slide, if you're coming up with something that's reasonable, you've thought it through, you're interpreting it the way that you feel it needs to be interpreted, you're doing what's reasonable, you're not finding ways to smirk, you're not finding ways to up the credit. And where I don't have any patience, and I know it would be none of you, but I don't have any patience for the, well, hey, so if I know I'm kind of getting close for third quarter, I mean, should I push some revenue? I'm cash basis. Should I push revenue into fourth quarter? Makes me very angry, because this is stimulus to help businesses that their revenues are down and they're paying employees. And so you let the chips fall where they may, which is more just to say, if your intent is not, how do I increase this credit? I know I'm going to include wages that are paid, even though I think it's incurred. Well, if you think it's paid, then go with paid, but then you got to be consistent with it. Don't get me wrong. I think going by when it's paid, as in here's the check to the employee, is not the way to go. But all I'm wanting to close with is, if that's what you go with and you do it consistent, and that's what you believe, then you have a reasonable basis. I think it's wrong. I don't think it's the right way to go, but it doesn't really matter. It's got to be what you think. And with the ERTC, as somebody noted earlier, this is absolutely very complicated, but actually the calculation shouldn't be that complicated. What are the defining factors of ERTC? And I'll close with this, because it was just the slides that I had at the beginning of the original seminar. The ERTC is this. What's the qualifying period? what are the wages in that period? And then what percentage is the credit? That's simple, right? Now I get it gets complicated of determining the quarter or determining gross receipts or what is gross receipts or what quarter am I applying towards. But when we get to, we determine that we qualify, we determine that we have wages that also then qualify, and we then are now trying to do the calculation. This should be the exciting part. And we need to move away, in my opinion, from being stressed out. I mean, do what's reasonable. If somebody doesn't want to report the ERTC wages in the quarter on the Form 941 of what it's actually paid, and they're going to insist that they want all of that quarter's wages that qualify, if they're doing it based on the reduction in gross receipts, to be all reported on second quarter, then just do it. It's not, I don't believe that's how it's supposed to work. But what I want to be sure is that do something, figure it out, file it. We don't need to necessarily be petrified of the IRS as it relates to this, because in that set of circumstances, was the credit correct? Which means, what was the wages correct? Was the health insurance included correct? Then your credit is correct. What quarter did you report it on? As I indicated earlier, well, what probably only makes a difference is behind the scenes of the breakout of wages between what's refundable and what's non-refundable, but doesn't change the actual credit amount. Now, does the IRS later go, oh, we're going to have to show some of these wages in this quarter and some of the wages that quarter? Well, it's not going to change your credit. I don't see how you get in trouble for that. If the IRS comes later and they say, well, gosh, did you ever take JJ the CPA seminar? I mean, didn't he tell you it's based on when it's incurred? So why'd you take it based on when it's paid? But if you do something consistently, and what I mean by that is, well, most of the time you should know with payroll, right? Things kind of work themselves out, right? If you're not trying to manipulate things improperly, meaning, okay, if there's biweekly, well, most likely every quarter almost has the same payroll periods, 2 payroll periods may, or 1 or 2 quarters may get an extra payroll period, but will it make a difference overall? I think it could. I don't think it's proper. But what the IRS would do is they go, okay, well, I know you based it on paid. This is what I believe. You based it on paid. It's based on incurred. So you go, okay, well, then based on incurred, here's the credit. Based on what was paid, here's the credit. What's the difference? You're either getting more, which probably won't be the case, or you got to pay some back. And you're going to have some penalties and interest on one needs to get paid back. But most likely there's not going to be a huge difference. Where the IRS is definitely not going to be happy is they're going to look and they go, wow, you had a whole bunch of payroll periods in second quarter and you didn't have anywhere near the same payroll periods in third quarter. Seems like you manipulated your payroll here. Then you're going to have a problem. So what it comes down to is reasonableness. The IRS is coming out, obviously, has come out with more information, then that's why you're here. So thank you for those that submitted the questions. I really enjoyed going through them. I don't recall what time we actually started because I had been delayed due to a funeral. So if we started at 4:15, what time are we at? 7:45. So 5:15, 6:15, 7. So my Q&A was almost as long as the actual seminar, but hopefully those that submitted it got the answers that you were looking for, and it was the value for what you had paid, which I appreciate. Most likely I'll have an additional ERTC update, most likely sometime in October. Feel free to email me to say, hey, JJ, do you think it's worth me taking your update? And I'll let you know, because if there's not a lot of new information, I know one of you in particular here emailed and said, hey, is it worth taking the number 3? Because I took 1 and 2. And I said, well, I think it's going to be about 25% new information. So feel free if you want. And then also for those that are looking to get continuing professional education, this will be the first seminar that will be for CPE, because this is the seminar that has already been presented for approval, if you will. So we'll be able to, I'll have some updates in that as well. So there could be some differences there. So without further ado, I'm going to say thank you. I really appreciate all of you. I'm going to hit end. And given that we've gone as long as we have, I'm realizing I'm actually 45 minutes late from meeting my daughter. So I am going to scoot from here. You probably all know this. If you want to put together a phone consultation, you can go to my website and you can find a phone consultation. If you're here and you've made it to here and you're here with me right now, thank you so much. Really appreciate it. Impressed. If those that submitted the question, if you need a clarification, and hopefully I don't mean you're asking a whole new question, but if you just need another clarification, let me know. For those that have an advisor that maybe wants to talk it through, and I don't mean I prove that I'm right, but if they want to talk it through, happy to do that, because at the end of the day, I know you're just trying to get it right. So thanks for not only attending Seminar 3 for the ERTC and being a part of that, but thank you for attending today. Again, thank you for those that submitted questions. So I just have to end every video saying this, because this one is going to get thrown up on YouTube, which is thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. And for those that haven't taken the seminar, that have come across this Q&A and you've made it to here, look in the body of this video for a link to the ERTC seminar that you can get immediate access to. All right, thanks so much, and we will see you.